Stocks, options, futures, looking at technical analysis, listening to J Powell today, watching The Spy, GME, barbecue, that gas, ripping. Want some more? Love up, like up, comment down. Happy money sticks around. Let me get set up here a bit. Morning Mo, morning Passing Cloud, morning Buzzin'. Thanks guys for your support on Twitter. Thank you for following me on there and retweeting. We need to do some Twitter spaces and get you guys spaced together chatting. Get this shared on Discord. Weird. Spy continuing to rip. We're just gonna squeeze. See if Powell dampens it. I don't know what to do. I want to take the long, but I just don't think it's gonna be very long lived. But that said, yeah, yesterday was a breakout, so increasing volume too. So might close my shorts today. We do get a pullback from Powell. Might try and get a quick exit, and then I mean, I don't know what he could say that would actually end this. Either yesterday was a false breakout, like a heavy false breakout, or yeah, we're on a little a squeeze, continuing squeeze. And 425, I think, gonna come quick. Even yesterday in my video, I was like, might even be hitting 420, 425, and literally after I did the video, almost we were like hitting 420 in after hours. Look at that, and now here we are again. Crazy. I didn't follow one of my rules. All right, nat gas ripping also. It feels like a chase, so I might just wait for maybe $8 on UNG and short it. Had the inverted head and shoulders here that we drew out, had the RSI divergence, so I caught some of the upside, did all right on it, took profits, and then that storage numbers yesterday just made it go crazy, and there's no way to know. I mean, that's just a roll of dice. And the continuation on it's actually pretty impressive. Normally you just get the reaction and it moves back down. Put the Discord link in the chat for you guys if you're not already on there. Happy TGIF, Tao. Morning, Ace. Stop crying, Lords. Morning, SHF. Win SLD, I know, right? Yeah, complete rip in SLD. Happy day, Aware. Thanks, guys, for your likes. Appreciate it. Pre-market. Thumbs up. This is the way. 10 of them. Okay. Let's see what's you guys chatting about on Discordian. No, you're not able to buy calls on barbecue. They're taken over by BBY nerds. So yeah, SPY's up 0.35% pre-market. Got 10 minutes to open. GME's flat. Barbecue. Oh, it was up. Now it looks like it's down a little bit. Closed. I might be cutting today short a bit. Yeah, literally, if I'd closed my short, I could close it at open, but if I closed it even here on that retest of yesterday's high 2 days ago and flipped to long, seeing that this is a bigger bull flag, I could have actually recouped all my losses just in that rip. Losses from here. But once it starts getting to the like high and frothy, I'm like, when I get nervous, it's just gonna flip and reverse on me. But oftentimes it doesn't, just kind of keeps going for a while. Moves slowly. Okay, dokie. Oh, happy day. Oh, happy day. Oh, happy day. When Jesus walks. When Jesus walks. Morgan Stanley's James Gorman plans to step down as chief executive officer in the next 12 months and assume the role of executive chairman. Oh. Ray Dalio, that's JP Morgan guy. Increasing the debt limit the way Congress and presidents have repeatedly done, and most likely will do this time around, will mean there will be no meaningful limit on the debt. This will eventually lead to a disastrous financial collapse. A plan from the SEC gives clearing firms new powers to make intraday margin calls. I thought we were already doing that. What happened to that? This is a response to the GME AMC 2021 trading and halts. I thought we were already doing the... What happened to like all the 2 p.m. margin calls? I mean, I got a margin call yesterday in the middle of the day. They're doing it to me. The mortgage payment needed to buy the median priced home for sale in the U.S. has moved up $2,500. New all-time high. 2573. Morning, Christopher. Customers are being asked to tip even at self-checkout. Yeah, I've seen that for like years. The like self-checkout kiosks or whatever. Six-month treasury yield has moved up to 5.38%. Highest level since January 2001. What's driving the move higher in the last few days? Odds of another 25 basis point Fed hike to 525 or 550. The June FOMC meeting. I moved up to 35% today from close to 0% last week. Wow, the SPY's ripping on that. Well, yeah, I guess if J Powell, if he is if he's talking any bit about raising again and not pausing, that could temper this exuberant rally we've been having. President Williams speaks at 8:45. Market selling off here. We've got about 3 minutes into open. Compensation for executives has risen faster than worker salaries in the past few decades. All right, we'll be listening to Powell at 11. Williams, come here, Williams. Sure. We can listen to Williams. Might get a bell at open actually. Get this for a second. We usually get, I don't think we usually get an opening bell, but we might. That's just in case. Like barbecue's down a little bit at open. GME is basically flat. 15 seconds. Much I recognize on the pre-market gaps. Vive la revolution! Okay, barbecue says it's opening up down 3%. 1750, that's kind of that support I want to hold. If that happens. SPY is opening up 2% positive. No more elevator music. Alright, there you go. The chat has spoken. You want elevator music. I hear you, I hear you. Don't have to yell at me about putting it on. I'll put it on. We're getting that Friday sell-off? I don't know. Barbecue. We did get the pump yesterday, but then it actually settled back down into the close. Interesting. Waiting for puts on AMD. Thinking about doing some longer dated, just like SPX puts with just like a large position and just kind of sitting on it, maybe closing out at like 100% in a month or two. But I want to wait till Powell. Wait to see if this is a real breakout. No barbacoa. We might be barbacoating today. Just you wait. What's on AMD at 10? 950. The gas is coming down a little bit. So what do we have? MGAM is up 5%. Jew, Nail, MNMD, FoxD's up 100%. MindMed. Stuff still waking up. Happy Friday to you all. Happy May 19th. Mac West up 5% and rallying. Flat. Dip for Turka. I just had to rip off that support, huh? I don't know. Hard to read this chart. Very volatile. It might, if it breaks that support, I mean, you've got some downside. Breaks here. My momentum's still positive though. Bullish MACD. So it might just settle down after that crazy pump it just had. Maybe consolidate. I don't know. Jihad. Barbecue 17.99. 1750 hold would be good, but not doesn't have to happen. We can break 1750. It's Friday. We'll give it a break if it does. No problem. Momentum is still in the right direction. Charge points flat. We got on a firm. Firm's pretty flat. Firm's still going to fill that gap up there. It's getting close. About our crazy squeezers yesterday, like Netflix. Netflix is down 1.3. Rivals up 4. was looking pretty good the other day, I think. Yeah. That looks like a nice flag. MVIS going again, dude. Look at this thing. That chart, that's crazy. Up 5%. Here, 5.5. Up. Pretty mellow out of open. Pretty mellow. Like Airbnb settled that back down. Whoa. Airbnb 3% down. Circa 2.5%. LXEH. Pre-market pump. Down 0.5%. 9. Well, my MU and my Nvidia. Unless if Powell crashes the market. Wow, look, MU actually broke out. What the heck? Didn't even notice that. How's it that buy squeeze, I guess? Spies now. Guess it's in green. Kind of wicked out of that bottom though. So J Powell, we'll watch him at 11. I don't think there's more then. With 93% of the companies now reported, S&P 500 GAAP earnings have come in much better than expected, flipping the year-over-year growth rate back into positive territory, plus 8%, for the first time since Q1 2022. Barbecue $17.99. Walls up 1.3. XW almost 7%. These banks are crazy, man. Crazy trades, just trading regional banks. Volatility is great. NEO's up 1.5. Had this divergence, made a little move, but it's been pretty mellow. NEO hasn't made a push in a while. Wow, Tesla's up 1.3. One more little gap up there, maybe. 183. Yeah, 183.92. I'm moving up a bit. Just been bull flagging since 2 days ago. Starting with that crazy 0-day SPX calls, according to FX Hedge. But yeah, that pump just started like crazy. That midday pump. Set off the short squeeze. Music is the balm of the soul, son. It is. I'm fine to leave it off for a bit, though. Yeah. Settle in a little bit here. LXEH. F. Microvision's kind of breaking out. Palantir. The Arrival, 4.5. Did Birds do a split? Oh my goodness. I didn't even know they did a reverse split. I noticed my options have an exclamation point next to them. I don't even know what that means. This option chain dead now on Birds? Are there no more options on Birds? No more options. What the heck? That is jacked. Suppose I could exercise them. Yeah, those are worthless, I think. Doesn't tell me what this explanation point is. You guys know? That's a dividend, the D. O is open orders. Oh, non-standard deliverable. Yeah, I think I can just exercise them. Because I don't even see any new options chain. But options chain for Birds, it's not there. I wonder if Birds will get a little squeeze. A little squeezy squeeze. Did they even like... They vote on this? Earnings. They proved 1 for 25 reverse stock split 19 hours ago. Interesting it didn't share purchase. They did the split and then purchase shares? That's what I'm saying. That's what Barbecue hadn't already way over purchased shares. That would have been the play. Another stock did that too, where they did the reverse split, expected the sell-off. During the sell-off from the reverse split, they did a big share buyback. Yeah, Birds might actually rip. I don't know. 20%, not much. Not much of a sell-off. It's back to break even. Bad. Rival 5.25. Barbecue now green. 1810. Households in Canada that took on a mortgage between 2020 and 2022 are carrying about 17% more credit card debt on average than those that purchased between 2017. There you go. The chat has spoken. I'll resume. If the mic sounded kind of funny the last couple days, thank you for your patience. I didn't want to mention anything because I want you guys to start thinking about it in case it didn't. But no one said anything. But then yesterday you guys were saying I was yelling a lot. I was like, I'm not yelling. But it should sound good now. It should sound maybe even a little better. Or hops. Microvision still going, 8.25. Laser up 4.7, ripping. Pretty good looking. Probably going for that gap fill too at 770. Started to yesterday. Turka 5%. Can't really get a good grip on what's going on with Turka. Had the pump the last couple days and I don't know where it's going. Has a gap up there. I mean, MACD's still bullish. Kind of making higher lows here. So yeah, maybe it'll keep rallying. I think it wants to today. Okay. Top is still suspended. Jeez, Mullen is getting wrecked. Down 8.5. Barbecue 18.20. Up 0.78%. Eggs Mullen. Looks like the AI stocks are back down. GFAI down 8%. Bulls, Nike. Wayfair down 3.6. Jump back into some cash secured puts on Wayfair. Don't like the chart that much. Roblox down 3.8. The bullish looking chart though. Yeah, I'll do some Roblox. Premium sell. Check the options chain. I'll look at June's. I think it could come down a little bit more before it keeps going, so I'm gonna try and not pick too aggressive of a delta. But yeah, it is in a nice kind of bullish trend here. Yeah, there's wide spreads between the strikes and Roblox, so not a great one for that. You've either got 42 delta or 13 delta. Ready to handle the dips and the rips. This is the way. Be the 35 and then put a high price on it. What do you climbing up here? It's above VWAP. an engulfing candle there on the 5-minute. Buy. Probably gonna get a gap fill here today. I would say for sure with Powell coming up too. GTII down 6%. Chart still looks pretty nice though. Nice show of support on that $3 level. Plus 900 on Nvidia. They're shorting Apple. Might have a little bit more of a push here. They have a little bit more of a short squeeze before the reversal. Plop. Friday dump day. Plop would be down also. You mean pop? Plop or dump? Both are down in my book. I don't know. There's no gaps to fill to the downside. So maybe just kind of flat with some intraday volatility. I really don't know. Yesterday we started a pump, so I was more bullish for today, but then coming into close it sold off. Back to break even. Maybe do something similar today. Down or flat. Yeah, I'm kind of there, I guess. I guess I don't really have an options chain to worry about. Need to dump it for. Blocks coming down. Barbecue 1812. Eyes kind of rallying a bit here. I'm gonna wait for Powell before making decisions on the futures. I think retail's down today. AC's down 3%. Nordstrom's down 2.8. Peloton down 2.5. Wish down 2.5. Wish is in a nice spot though. Why is it chill? Can't chill when it's squeezing, man. Yeah, SPY's about to make a new high on the day. Getting into, yeah, we've broken all the highs. Oh, I mean, 425. We're onto these levels up here. 424. Probably kind of a vacuum up there too. Not much traded there. With the VP. Yeah, see how little volume trade up here? Can move much quicker in this area. But I don't know. I don't have a good hit. Pal is what he's isn't an FOMC or anything. What he's talking about today, I mean, is it that much of a market mover? That's what I wasn't sure about. AMD, man. Me down 2%. Down with the rest of the retail. Gets a new bounce on that 2260 level. W key is halted. What? Weird. Halt up and then halt down. FIE. Microvision 7.6. Arrival's going a bit. 7% on arrival. Yeah, I still like this chart. It's kind of a sketchy position though. Non-compliance. Oh yeah, delayed 20F filing. That was on the 5th. Good. Ending cash position. Arrival reports Q1 business update. Ending cash position of 130 million. Business combination agreement with Kensington Capital to provide additional manufacturing expertise and up to 283 million cash in trust. Kind of bullish. Rival 7.8. Oh. Could jump on board. I like it. Get a little starter position in arrival. Didn't move back to VWAP on it. Inverted head and shoulders there. Kind of in this flag too. BBBYQ plus 2%. Eye with a red candle. Made one engulfing today. Here's the second one it's maybe making. Yeah, that one goes. Bouncing a little bit. Alright, I got some Arrival shares. I end up on Discord. SpaceX says standing down from today's launch of the Iridium OneWeb mission. Eurostoxx volatility index slides to lowest level since February 2020. Last down 0.6 points. There's a big red on SPY. Going for that gap fill, 4 hops. Put some levels on boards. BBBYQ 1838 plus 177. SPO is up 6%. Oh yeah, this chart looks nice also. Look at that flag. Microvision 7%. Firm down 2.8. Charge point green, red to green. Up 0.5%. Ubo down 1.3. Still in a pretty nice formation. consolidating, it looks like. Holding above the support would be good, that 164.9. 2268 down 1.5. Again, yeah, holding 2216 on GME would be good. It is Friday. It is OPEX. The triple witching today too? I don't even know. I don't think any of my futures expire today. Just a normal OPEX. It was up 1.2. MACW positive 4 now 4.8. All negative half. I did make an engulfing candle in the 5-minute. Oh, pushed VWAP down. That's really weird. Look at this VWAP. I think we're going to retrace some of today's rip rally. And maybe a bunch of volatility when Powell comes on. Say Powell. Yeah, 6%. Compensation for chief executives has risen faster than worker salaries the past few decades. Okay, we already read that, I think. Cafe shop in Toronto named the Anarchist, which was a self-described anti-capitalist establishment that had a pay-what-you-can model of operation, has announced it will shut down after being open for only a year. Legit. W key resumed. Oh my gosh. Halt down, halt up. I think we will just show us a weird chart. W key's ripping for new scalpers out there. 54%. Not sure the catalyst on this one. Oh yeah, I said that move the other day too. International Holding announces agenda items to be approved by shareholders. Reverse split, 50-1. W key and FOSSA systems to launch new YSAT ready satellites with SpaceX? No way. There's your catalyst. Working with SpaceX? W key? Come on. It's you. WiseKey and FOSSA systems to launch new YSAT ready satellites with SpaceX. WKey, a leading cybersecurity IoT and AI company, announced that in cooperation with FOSSA will be launching several new YSAT ready FOSSA powered satellites with SpaceX, according to the 13 FOSSA satellites already in orbit. These new satellites will be part of the 80 satellite constellation which FOSSA has been planning to deploy since early 2022, aiming to provide global and real-time IoT connectivity for industrial applications with 10-hour data latency. The launch will be carried out by SpaceX on Falcon 9 vehicle no earlier than June. So the SpaceX thing doesn't matter. They're just using SpaceX rockets. Right. The next generation will deliver high capacity services. It's bullish that they're launching, I guess, but it's not like some kind of partnership. I mean, it is in a way, but the next generation will deliver higher capacity services in a commercial manner for a wider range of applications, supporting IoT and other space-related services in areas such as communications or remote sensing in the fields of signal intelligence. YSAT satellite is a security IoT hardened nano satellite designed to further drive down satellite costs for IoT applications. Well, it's making a nice bull flag there on the 5-minute. Barbecue 1838 plus 1.7. W key 49%. A lot of volume. Liking it. Good lead to partnership, yeah. Arrival doing it 7.8. So I'll probably just throw us like a stop on this thing, a stop loss. We'll see how high it goes. Go for just a swing trade on it, I guess. I put an order to sell some barbecue. Free up some capital to be throwing this or some other stuff. GME bouncing a bit. I also bouncing some. GME back to VWAP. Down 1.5. Barbecue 1838. W key. Run VWAP. FFIE 6.5. Mavis 6.5. The share of debt balances that became at least 90 days delinquent in the first quarter of 2023 was 1%, up from 0.071% a year earlier. Still very low, but the percentage increase is pretty significant. Almost 38.5% of American homes, the equivalent of about 89 million, faced difficulty in paying for usual home expenses between April 26th and May. Alright, we've got, let's see, pals in 45 minutes. Where we'll watch them yet. We'll find it. down 3.3. Ah, Zella. How's our Zella? Our Zella crew. Down 11.5. Back to, wow, even lower than where it sold off from the reverse split. Guys, pretty much flat. Looking over some cash secured put. Inner coins on there. I'm not too bullish on coin. I think a gap to the downside will probably fill before the upside. Agbawa. Nope. Oh yeah, IEP. IEP. Yeah, I think I want to do some IEP. Wait, is today the ex-divvy day? Is. Maybe do a little dividend arbitrage in this one. Got here. 630 strike. I might be down for that. Pretty high delta, but at a low. There's not like any bullish momentum yet, but I guess it keeps making higher lows here potentially, but also lower highs. They're just triangle wedging. Cheese wedging. But it's doing that after a big sell-off, so potential flag. Oh, can IEP go? I like the cash secured puts on it though. That 15 RSI on the weekly. Wow. $30 strikes at 33 delta. Down for that. So typically after ex-divvy day, though, you do get a sell-off. We've seen different stuff, varying stuff. There's some people playing the dividend arbitrage. Here actually did. Got it after the day. There, yeah, started to sell off. But it started to sell off even before it. Actually, this one historically has pretty big sell-offs after the divvy. Kind of commonplace for it, so maybe I'll wait. I'll wait on the cash grid put on there. Why it's coming up on the screener is a high premium on it because people are playing the long puts, expecting a sell-off after it, which might not be a bad idea actually. Buying the puts. I might buy puts on. Have any buying power because my margins in MES. Yeah, I think puts on IEP actually probably not a bad play. Pretty consistently sells off after the divvy date, and it's in more or less a bear flag. SLG. Help management to read. This be high on this scanner. Right. Yeah, there's Volatility. The news around SLG right now. I've seen other people talk about it too. Oh, it's got a high divvy. $14.7% paid monthly. Look at this. Someone's got a whole article talking about a put writing strategy. Right, 15% yield with 56% downside protection. That is neat. Huh. None of my Weeble articles are loading. Yeah, this looks like a dividend trap. I don't like it. Coles? Earnings coming on Coles. Arm down 3%. RF. W. A double bottom there. There's another REIT. Another divvy trap. These REITs have been getting wrecked. Guess what REIT am I in? In FO? I can't remember now. Yeah, that's a REIT. That one's doing well. I want to get a cash care put on a REIT. VFC. We have earnings. Palantir's on here. Not gonna mess with that. That's not bad, actually. Yeah. The SPY really just flat. Moved back up a little bit. It's positive 0.33%, but pretty flat on the day. Still waiting on J Powell. Pow. Thanks guys for your likes. Coming up on 10:30. Got 24 likes. I appreciate it. A slow morning until we get Powell. It is May, and we're almost done with May though. So sell May and go away. Leads into April. I don't know. Buy the dip. What do you mean you're at the top of the BBBY sub? You have a post? You have a post up there? Post is pinned. Share it. Is it on Discord? Want that a little bit. Oh, the dates. Yeah, that is useful. SPY getting close to the high here. Have they changed a lot? I mean, oh, from all the they pushed them all back, right? Basically all till like beginning of next month now. GME down 1.7. Weeks later, bullish. It could be bearish. My first initial thought with delaying stuff like that would be lack of demand. So they're trying to give them more time, gather more demand. But sure, you can look at it however you'd like to. Seek and you will find. Davis, 9.3%. And Microvision. PaySafe's up 4%. Oh, that thing broke below its support there. Might be a good short. It's not looking very hot. Go Neo was up 4%. Probably wants the best price possible, of course, sure. More time, new buyers. New buyer appears. So one they weren't prepared for, you're saying? I said Neo, it's right here. Moving up 3.7. Hey, away. We got some cash good puts on it. Nice little premium sell. Pre-planned to drive the company down. They don't need that extra time. Well, yeah, that's if you're under the notion that this was pre-planned to drive the company down, which I guess I'm not under that assumption either. But they've moved around dates and stuff so often, it's like you kind of just have to take it at face value because we still have no idea. MCOM ripping up here, 8.25. This never had its reverse split squeeze. Maybe it's starting now? Right now? I think so. They held that one way too long. That was stupid. Or the 4.5% list is taking time. Yep. SPO 6%. MVIS. I mean, buy near the high. MACD flipped bearish. Might be getting a little double top here. I don't know. They're just chopping around waiting for pow. W key moved back down below VWAP. Biden informed the G7 leaders U.S. will support joint effort with allies to train Ukrainian pilots on F-16 fighter jets. The median price to sales ratio on the Nasdaq 100 has moved up to 5.4 times its highest level since last August. bottomed at 4.2 times last October, which was 50% lower than the peak valuation of 8.5 times in November 2021. Al stocks, it's pretty flat, down 1.7%. Sorry, that's GME. Al stock is a little better than that, up 1.8%. Pretty flat on the day. 1840. Did have a little wick below to 17 cents this morning, but holding back up to kind of yesterday's VWAP. So doing all right. Barcoding. The use of AI by China's military has spurred U.S. fears of an arms race and potential conflict. One reason to expect a U-shaped rather than a V-shaped recession is that different parts of the economy are weakening at different times. That's per Bank of America. 30% of Gen Zers owned homes at age 25 in 2022. Gen Z. I owned my first home. I was 18. I didn't own it outright though. I bought it, or not outright, but on my own. I bought it with a brother and a sister. Best investment ever made. Tesla is serious about plans to set up production innovation base in India. Minister. Bank of Canada is growing more concerned about the ability of households to handle their debt. Higher interest rate environment, which more homeowners relying on credit cards to meet expenses in the face of steeper mortgage payments. A recession and a credit crunch could result in $1 trillion of corporate debt defaults, says Bank of America. The CME is prepared to leave Chicago if the city and state take steps that are perceived as ill-conceived. SPY moving up here. Dink called out MGRM. Wow, what a pump and dump there. That's crazy. Me down 1.6. Barbecue 1821 plus 8%. The market capitalization of Apple has surpassed that of the entire Russell 2000 for 2 weeks. The longest stretch on record. What? It surpassed all of R2K. That's crazy. It was the market cap of it was also greater than all of like UK's stock market. Something. We read that last week. I've traded some biotech. Not a whole lot though. I don't follow it too much. I messed around on the last PDUFA date. I traded a couple just I didn't hold through the PDUFA date, but I traded on the because they were rallying up into it, kind of anticipatory rallies. Why, do you got something for me? Spy's coming down here a bit. Gotta figure out where we're gonna watch J Powell. Maybe he'll be on.
Struggling now with the brand
with GME.
issues. It is exactly, and then, you know, in New York they're like right next to each other.
I know, yeah.
So messy.
And then it's always like
I'm moving down to VWAP. VWAP's been weird today.
All right, who's in each store?
Yeah.
Athleta is always so much more empty.
It is. It's always so much more empty. So, like, that's an issue with him. You know, they got to figure out what to do with that brand. And so, this company is also several cost-cutting opportunities.
NMP.
However, that the
Yeah, this is one of the ones I looked at before. They already had their
this time in a little bit of a better position, but
their
can't
date.
deny those expectations as well.
Okay. So
Hard to like. You can look at TA on these, but they're so heavily weighted on those trial dates and stuff. So really just looking for like a pre-trial date run up, and then assessing what you want to do at that point. If they don't make any money, I mean, there's bigger ones, of course, that have those too that are making money, and then you can kind of do it. Otherwise, these are just they're basically dying stocks until they get some big drug or whatever approved.
Push higher coming into this year. I feel like with so much else rallying right now, this is
you're really claiming that, Trace. Did this? So what was the pump earlier? Was that? Oh, they had earnings that caused a pump. Interesting.
Significant
What this is?
downtrend off those yearly highs near 1550. It was looking like we might have established a new leg upward here, but it wound up just being a double top.
They had earnings yesterday.
Short at roughly the same area both times here.
3 days ago they had earnings.
Given way to a more shallow downward channel here, but it's still, you know, not looking too good for the bullish crowd here. We're just a hair above that -2 standard.
I would just look at their next date, or I don't know if it's a PDUFA or whatever.
Tuesday, I believe, Tuesday.
Or here and see.
Channels I thought could help us analyze this.
The chart looks nice.
Because it's showing us that price is at a relatively extreme level right now. This blue line is our linear regression line. That's our line of best fit based on closing prices. Then we create these channels by taking standard deviations above and below that point here. So because we're close to that,
yeah, the chart looks really nice.
Channel, it tells us that price is at a pretty
got a nice low there.
Level. So this is a more volatile.
Seems like it holds that support pretty well.
And we can see that anecdotally,
again, keep an eye on, figure out the date
get too far beyond -2
where they have a drug trial or whatever. And I mean, for me, I would close before then. But yeah, might have a rally up into it.
My own personal observations is that
seems like their earnings were well received.
Starting to be stretched pretty thin if we're getting at +2 or -2. So
trial.
that would be around the 760 level for some potential support. If we continue to break downward here, the -3 channel comes in near 565. That would be quite ugly for anyone trying to be long in this name here. But looking to the upside, some resistance would be our 21-day EMA near the 850 mark. That's pretty close to our upper trend line in our channel as well.
Okay, so the hope then for gap bulls is that the selling might slow, but there's not much sign of a turnaround.
Not really that I'm seeing here. We had a nice couple days, you know, of upward movement here, but it looks to me like it was perhaps just a bounce off this channel where we might expect to find some support based on its own price history here. Okay. But nothing really that's transitioned into a lasting uptrend by any means yet.
Earnings next week, so we'll get the update from Gap here. All right, last one on the consumer list, Alibaba. Let's go to China. Let's talk some e-commerce, Renita.
Yes, first price target cut on this stock coming from Citi, cut the price target to $144 from $154. That still suggests about a 71% move to the upside from where it's trading today. And the analysts did keep a buy rating. But here's the thing. Citi noted how this company did see fiscal 2023 in line with revenue, and it saw better than expected profits. But Alibaba is starting to spin off into those 6 separate businesses that it talked about, and analysts feel like that move to spin out the cloud business could draw some more political pushback, right? This is not just anecdotally. They say that the cloud division has already started to lose market share to its competitors, including Huawei and the state-run China Mobile, and they feel like this could grow into a bigger issue further down the line, Oliver.
Okay, so they're still trying to navigate a complex political situation from the Chinese government.
Exactly, and especially since the Chinese government has this huge tech crackdown happening right now, too.
Yeah, so cut the price target. Still above, though, where we're trading by a fair amount. Chart maybe finding some support down here around $80, Rick?
Yeah, around the $81 level is a point that's had my eye for a while here, this green dashed line. Interesting chart, though, because, you know, once we hit these lows near the 58 mark, we almost doubled all the way up here. Still wasn't enough to take out those previous yearly highs, though. Then a big collapse, slightly smaller resurgence back upwards, then another collapse. And here we find ourselves where 2 days ago, we were crossing above the orange 63-day EMA and our volume profile point of control. It was looking rather promising. We were seeing some the RSI starting to trend upward there. Previously, when price was making lows, we crossed above that 50 threshold in the RSI that shifts between bearish and bullish momentum. It was looking not too bad there, but things fell apart yesterday. Big rejection at that resistance point near 90. Today we're finding ourselves closer to 81 now again, where we had this double bottom type price action forming here and here. So that's the point to watch to the downside. To the upside, our yellow 21 EMA near the 87 mark comes in right below, or rather right above where we are now. And beyond that, we've got the intersection of our 63 EMA and our volume profile point of control near 90 once again, to be watching for some resistance here. But overall, the trend is still pointing downward. The moving averages that we follow, the slope of all three is downward. We're trading below all three of them. You know, it's not looking like we're in for any kind of upside breakout anytime soon.
All right, so a little bit of help bouncing off $80, but still have this kind of
highs moving down here a little bit. Still just chopping around in this range. We've got
longer term,
I think 15 minutes to power.
Short-term history here of a lot of faded rallies.
Okay.
So it's been very tough for Alibaba, especially for investors that have
double bottom on AI.
Around
Careful though, that is definitely a bubble.
You know, on the year down a little bit, so. Not the best looking chart, not the worst. Okay, we'll see how they navigate.
Don't know what's going to pop. Next
and
market downturn.
Keep talking some retail when we come back.
I think very possibly will be a popping of that bubble, at least temporarily. There's been a lot of capital pushed into that based on nothing. So, yeah. Especially just these rando names. This is trash, this company. First splits and just has AI in its name. AI itself, yeah, it might be a survivor. Of course, like NVIDIA and those have AI exposure, but so is GME. GME's what, a bubble? Not in like a bubble sector, I guess, like AI is right now. LBM. Electro Battery Material Corporation. Bouncing after bad earnings. Longer downtrend. Axart. Yeah, this chart looks nice. Very nice. Better than my Arrival chart, but this has already made a much bigger move than Arrival. SPY coming down some more. Still above VWAP. Oh, GME. Yep, GME coming down a bit. Quarter. West coming down some. Plus 2 points. Walls down. Still up 3. Kubo down 2.5. Charge point down 1.25. Down 4.5. Up. And a bounce on view. And
analyst community still feels relatively
some
neutral
Jenny's in
on
the
this
chat.
name. I'm definitely seeing a lot of these analysts today come in slightly adjust
Hey,
their
kind of
price
retesting
targets
its
to the
low.
upside, but UBS,
Hey,
Piper Sandler,
that gas
Wedbush
up
all
2%.
have neutral ratings on this stock. Credit Suisse actually the most bullish on this name with a $12 price target and an outperform rating. The average price target though is about $11, which obviously would imply shares more than doubling from their current price. And this name has lost about 40% of its value over the last 12 months. Like you said, Oliver, just one of those pandemic winners. But I think it also is just encouraging the fact that this echoes very similar sentiment we saw from another luxury peer, LVMH. So definitely goes to show that those that are shopping at this
Got about 10 minutes till
are
Powell.
still spending. And I think that shows the broader theme that those that are operating obviously in a more high income space are not feeling the pain of some of these inflationary measures as much.
True. Though I still am skeptical of whether or not this will be the medium in which people spend on that luxury, because I mean it was at $74, so it feels like the last year and a half was the market kind of telling us that people are going to go directly to the source as opposed to kind of an intermediary, and that even if they did, this was not going to be it. So I don't know. I mean, it's hard to ignore the 20% rally, but $5. We were at 74. I don't know if that means it's like back in the good graces just yet.
I think there's a lack of trust because I think when you're buying such high ticket items, you want to go directly to the source because there is the theme that there's like knockoffs right now flooding the market. I think if you're going to spend over $1,000 on like a shirt, which is what I saw this morning, which was ridiculous, you're going directly to the source to ensure that you're getting an authentic product.
Yeah. Right
It's
now
still
in the
strong,
men's
yeah.
section,
It's holding the
some of
same
those
level
best
from
shirts
yesterday.
include
So,
a Versace
yeah, just barber coating,
print
really.
silk pullover for $13.50. A Burberry check print silk
Green
shirt.
candle
that's
there on
just
SPY.
awful, by the way.
Flip out of
That's
VWAP.
about $12.50. I do like the St. Laurent Hawaiian shirt palm tree pattern now. $890.
It's not cheap. That's what I'm
So-
saying. I found a pair of jeans
Yeah.
that were $5,000.
Yeah, Maz missed it. Yeah, that's a good point.
You know, you can.
Yeah, May is
it's
slow.
It's a little pricey. It's a
Exuberance
little,
will be
See what shirts
low.
up there high, though.
yeah. Okay. All right.
We're almost over, but
Hey,
yeah,
all
just the
we gotta
summer
do
months in
is sell,
general.
like a couple items.
Usually slower.
You know, and they're making good money. Okay, appreciate it. Thanks, Jenny, for the update. Farfetch up 22%.
No, Friday
I got
afternoon
Nick
yet.
Theodorakis and
True.
Scott Durfee with
Yeah, I
me
mean,
here this
I don't know if we
morning
get this
to,
like a Friday sell off or
talk a
not.
bit about the broad market and the economic situation.
I guess
We'll
last Friday
get
it's
an
kind of
update
part of the
from
reason I thought we were
Mr.
going to get a sell off
Jerome
was just that
Powell
gap fill,
shortly.
and it
Is he
did
gonna
it
rock
like
the
clockwork.
boat?
It was
Scott,
crazy.
What do you think? Is he
So
gonna look at this big rally the last couple of days and go?
I don't
give me
know.
a
I don't
break?
know if we go with this Friday or not. We do have a gap
I don't think that we're
up
going to
here, I
see
guess,
a whole
huh?
lot of movement because of it. You know, we do
Oh,
need to
that's
pay
just
attention,
intraday.
and I think that they will too, not just to the rally, but a lot of the economic data
Hey,
that's been
Tainted, what's up,
coming
man?
out. But we
Horseman.
Key and Powell speaking today will just kind of be a culmination or the cherry on top of a whole bunch of other Fed speaks that have been going on all week. And so I'm expecting that the theme will kind of be consistent. You know, let's not make any rash moves in the upcoming meeting, which is just a week or two out, and just kind of hold the course because, you know, we've been getting some good information. You know, earnings have been pretty good. However, the bar was set a lot lower for this earnings season by those making the estimates than we've seen in the past too. So we've got a lot still that's coming to fruition, coming to head. We'll see what happens, but you know, they start in about 9 minutes now, so it'll be interesting to see how that talk goes.
Yeah, what do you think, Nick? Is this stock market rally becoming a problem for Jerome Powell trying to suppress the economy?
I think so. You know, I'm just pulling up a couple of charts, y'all, looking at you know, the 5-day trend here, and the 10-year yield's up about 10% in the last 5 days. The dollar is up like 3% in the last 5 days. The S&P, we're right up against that 200-day moving average, and you know, breaking potentially breaking above 4,200 here if we were to hold this level on the close. I guess it's all related to the fact that, you know, Congress is telling us that there's way more likely a resolution than a stalemate on the debt ceiling, which is great short term, and I'm not being dismissive of that, but it still doesn't exactly, you know, figure out the whole long term problem we have where inflation is running at least double what the Fed is telling us they want it to be. The market is expecting, you know, interest rate cuts. And, you know, the Fed's telling us that they're going to hold firm, you know, with a few folks out there that are voting members saying that, you know, they may have to increase rates further. So I think once this debt ceiling piece is truly behind us, we get whatever the resolution is, whether it's, you know, a big bang or it's just kind of a kick the can. I think there will be a return to focus on, you know, what is the long-term interest rate plan here? The curve is, you know, still crazy inverted, and maybe some of that does correct with the debt ceiling coming to a head here. But I just don't think it solves that underlying problem. And we don't really have a lot of data to go off of for the next, you know, week, right? PCE isn't until next Friday, and it's a very quiet data week. We get durable goods kind of midweek, but there isn't a ton of data to go on, and all the Fed speak is happening here, and vol is low. So I guess it's a little combination of get the debt ceiling under control, get into Memorial Day kind of mode, and the markets are just coasting. But I'm a little curious that we've held this rally as much as we have, given the kind of medium term uncertainty that still remains.
That uncertainty around what the Fed's going to do later this year. Michael Scholl at the top of the show said that there's a possibility.
Okay, I got the J Powell stream up.
Into the pricing, potentially even for next month.
Let's just hear it, J Powell. So you're gonna raise 50 basis points.
That, at what point does it become a problem?
That's coming in June.
If you look at Fed funds futures,
Don't see any.
you know, like a 10,
Hiking of
15%.
rates.
If that starts to make its way up to a coin flip, Scott, do you think that becomes an issue for stocks?
Get the party started.
Well, I I don't think it becomes an issue for stocks right away. I mean, there's still a few things that do need to pull through too, right? We've got the employment data that's still kind of, creating a little bit of heartburn for the Fed. And as long as that stays up, we've heard George say many times that, mathematically speaking, it's just impossible for us to move into a depression, or a recession, as long as we see these unemployment numbers, as it were, like they are. And so, that's another thing that needs to come into play. But, the overall sentiment as we've come out of this week, the overall sentiment of the market's actually been, I think the word to use is quite joyful, right? I mean, we've seen a lot of good things happen in terms of sentiment. Now, whether that sentiment is making an accurate assessment on the companies that are reporting earnings and the things that are happening, I guess that's yet to be seen. But as long as that sentiment's there, the stock market will continue to move. And I think that the Fed will have to, I agree with Nick, that the Fed will have to respond to that sentiment for sure.
All right. By the way, I didn't even realize we're actually up to like 37% for a hike in next month's meeting.
Wow.
So the odds are moving up here. Market seems to be shrugging it off so far. Maybe 50 will be the magic number. Yeah, real fast, Nick. You got about 30
Dollar's
seconds.
kind of rallying there.
No, I just think, Oliver, we started off the week talking about kind of how the higher end retailers, where you and Jenny hit that, Walmart's unchanged, Home Depot's down. I think we expected to see kind of lower end retailers do really, really well here. And that's not coming through.
GME's down
So
2%,
one more
2.25.
feather in the cap that inflation is still hanging in pretty
255
solid.
still.
Okay. Appreciate it, guys. Thanks for the thoughts, Scott Durfee, Nick Theodorakis, Trading 360.
Thanks, guys.
Caroline Woods is up next. I will see you on Monday. I'm off this afternoon. And have a good weekend. I'll definitely be watching
bottom
the
on
close,
GME.
though, so maybe look for some tweets.
Maybe.
I think
See what the
second
SPY
half will be
brings.
Very interesting today if Jerome Powell actually addresses that rising chance of a hike next month.
It's good for the peso though, right? Bad for the dollar. Barbecue came down there, 1791. One of the levels I'd like us to hold. Actually kind of just in this area. Of the whole area. Sorry, not there, yeah, 1790. Oh, J-Pal. Here we go. J-Pal.
All right, I guess we can get started. Thank you all for being here. Of course, it is a true honor today to have Chair Jay Powell and former Chair and Nobel laureate Ben Bernanke with us today. Thank you very much for being here. I've very much been looking forward to this conversation. I'm sure our audience has too, so let's just get to it. This conference, as everyone knows, is dedicated to the memory of Thomas Laubach. And earlier this morning, we heard some personal reflections on working with Thomas from Secretary Janet Yellen, also former chair.
Let me know if you need it louder.
And from President John Williams. And both of you worked closely with Thomas as well. So I'd like to give you both an opportunity to share your own thoughts about Thomas's contributions as an economist, as a central banker, as a colleague. Ben, maybe we can start with you.
Sure, and it's great to be here. I was Tomas's thesis advisor, and he worked with me on a book on inflation targeting when he was still a graduate student. And that was a long time ago, and he was not yet in his exalted position at the Fed when I was doing Jay's job. So I don't have any short little anecdotes to give, but I do want to say that I think there's sort of two kinds of accomplishments a person can have. They can have curriculum vitae accomplishments, and they can have what I call eulogy accomplishments. Curriculum vitae accomplishments are things like published papers and promotions and awards and recognition. Eulogy accomplishments are the things your family remembers. You know, your kindness, your support, helping other people, and so on. Tomas was one of the few people who scored high on both dimensions.
Barbecue coming down there.
On the CV side, you know, beginning with his work with me, he had a tremendous input into the Federal Reserve's framework, working on inflation targeting, working on the more recent Fed framework. He did work, I'm sure John Williams talked about his work with Tomas on the natural rate. He worked on the effects of deficits on interest rates, again, another contribution. So a person who made a lot of intellectual contributions at important points. But as a person, he was just a very warm, kind, friendly, helpful person, and he was just a joy to work with. And you know, I'm glad to be here to, you know, say this about him.
Thank you. Jay?
Thank you, Trevor. So first of all, let me say this conference is a very fitting tribute to Tomas, and I'm really delighted and honored to be part of it. And let me add my thanks to those of us who made all this happen here today. So I first met Tomas when I joined the board as a governor in May 2012, almost exactly 11 years ago. And in preparing to join the board, and then in my early years at the board, I was very focused on developing, you know, a deeper background in macroeconomics and monetary policy. Many people here at the board supported me in that process, too many to name here, but I will say Tomas really stood out. And it was during the process of reading, you know, the literature and discussing it that I really started to get to know him. He had this great ability to communicate complicated ideas. He obviously loved talking about economics, and his great enthusiasm and willingness to engage with me, a new governor, was immediately evident. He was very gracious to me, and we had a lot of informative discussions. So rather than being his teacher, I was really his student in those early years. As you know, by the time, as you noted, Trevor, by the time I became chair in 2018, Tomas was the head of the Division of Monetary Affairs. And in that role, he was a trusted advisor to me and to the FOMC. His leadership was particularly important as the FOMC conducted our first ever public monetary policy review. He played a major role in organizing that, identifying key topics, and organizing the staff all through the Federal Reserve System. He also played an absolutely essential role during the critical period of the pandemic at the very beginning, when we were marshaling our forces and our tools to stabilize the financial system and protect the economy from even more dire consequences. And through it all, he did come through as, not just for his dedication, his great intellect, and his mastery of monetary economics, but also just for his kindness as a human being, and just as in being a terrific, great colleague and a great person.
Thank you. I think there's a lot of agreement for the sentiments that both of you have expressed. Appreciate that. Before we get to some questions on some current issues, I did want to ask you both about any formative experiences that you may have had that have shaped your views, particularly about your thinking about monetary policy. Paul Volcker, in his oral history interview, tells the story of his mother, who was adamant that he received the same dollar value monthly allowance when he was in college that his older sisters did 10 years prior. And of course, he was not too happy about that, because inflation in the interim had obviously eroded the real purchasing power of that allowance. So as the story goes, that was the beginning of his personal commitment to price stability. So Jay, do you have any such stories to tell?
Maybe not quite that on point, but so I graduated from college in 1975 during what we now call the Great Inflation, and same college year as Ben. And I started working as a lawyer in the financial sector in the late 1970s. I recall from that time a growing sense that high inflation was essentially a permanent part of the landscape, just something that we all had to accept and deal with, and that the costs of getting rid of it were too high. So you just were getting used to it. Of course, ultimately, the Fed did step up and restore price stability. And one lesson from that era is that price stability is really the foundation of a strong economy, and that the economy doesn't work for anyone without price stability. Another is that high inflation when we have high inflation, it is the responsibility and the obligation of the central bank to restore and sustain price stability. So today, while inflation isn't as high as it was when I was in college, it's nonetheless far above our 2% objective, and many people are currently experiencing high inflation for the first time in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it reduces purchasing power, especially for those who are at the margins of the economy and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other essentials. And that's why the committee is so strongly committed to returning to our 2% goal. We think that failure to get inflation down would not only prolong the pain, but also increase, ultimately, the social costs of getting back to price stability, causing even greater harm to families and businesses. And we aim to avoid that by remaining steadfast in pursuit of our goals.
Thank you. Dan.
Well, I had mentors, Dale Jorgensen at Harvard and Stanley Fischer at MIT in particular, but I'm going to tell you about something that happened to me when I was 6 years old. I used to visit my grandparents in Charlotte, North Carolina during the summer, and I would sit on the front porch of their house and listen to my grandmother tell stories about her life. And she told about how she raised her family in Connecticut in the 1930s during the Great Depression. And it was a town that was specializing in shoe manufacture, and during the Depression, a lot of the factories were shut down.
SMX waking
And
up.
she told me that, it was a very hard time. A lot of the kids went to school in tattered shoes or maybe no shoes at all. And I said, Grandma, why would they do that? And she said, well, because their fathers lost their jobs. Why did they lose their jobs? Because the shoe factory shut down. Now, I was only 6 years old, but I could see the problem with that argument. I said, well, why didn't they just open the shoe factories and make shoes for the children? And she said, it doesn't work that way. But I think it really was a puzzle to me that you had the same productive capacity in 1933 that you had in 1928. And in 1928, people were dancing to Charleston, and in 1933, they were in bread lines. And that really impressed on me, that economics can make really big difference in people's lives. And monetary policy is like that. I mean, it's, as Jay, of course, and all of you well know, that the decisions made in this building have a very broad and real effect on people's lives. And for that reason, besides its intellectual fascination, it's worth studying and understanding.
Yeah. Thank you. I know that's certainly a key motivation for many people in this room to be working so hard. Okay, let's now turn to some topics of more current interest. And I'd like to start with the nexus between the financial system and the macroeconomy. Both of you, during your tenures as chair, have faced very significant historic financial crises. Ben, obviously you confronted the global financial crisis, and Jay, the global pandemic. Those episodes were clearly acute, very vivid examples of the connections between the macroeconomy and the financial system, as well as, I think, a good illustration of the role of central banks in such episodes. But Ben, your research, importantly, and the research that you have inspired, has really demonstrated that understanding the connections between the financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this. But it was a classic situation where they had assets that were subject to risk, and in particular, as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate, but they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, the good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors. The third stage of a banking crisis is contagion, and people looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that. And that caused people to begin to remove, deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions. And the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on
affecting PAC-W right now,
the real economy. So, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways, including its scale and scope, of course. But I would mention a couple of things, a couple of important differences. One is that the impaired asset in this case was U.S. Treasuries, which are very different assets in kind from subprime mortgages.
Yeah, it's really moving the banks a lot.
U.S. Treasuries can always be valued accurately, and so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy declines, if it does decline, U.S. Treasuries actually become more valuable rather than less valuable, and so there's kind of a counter-cyclical effect. So that's one very important difference, I think. And then the other worth mentioning, but very important, is that relative to, say, the GFC or the Great Depression, overall, borrowers are in much better shape, than they were in these previous episodes. And that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and the economy in general.
Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that has come at, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised renewed discussions about the so-called separation principle, right? And so I wanted to ask you how you think about the use of financial stability tools and liquidity tools as opposed to more traditional monetary policy tools and how they fit together.
It's an interesting question, but I want to start by saying, though, that the overall, the banks and the banking system
that's right, Jose, you can't buy options on BBBYQ.
And resilient and well-positioned to deal with the challenges they face now or in the future. So, as you pointed out, we do have separate tools, monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation, this is the separation principle, separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain.
Saw big rallies on it when the banks were selling off. SPY's coming down here.
Thank you. And of course, that I think the effectiveness of those tools is reflected
SPY's green to red now.
In the fact that the FOMC has actually raised interest rates twice since the emergence of the banking strains. Of course, the purpose of that is to confront the inflation issue, which brings us to our next topic.
We met with a decision to close shorts and go long.
You know, in the pandemic and the aftermath, we've had many renewed discussions of the important and classic textbook distinction between supply shocks and demand shocks, and in particular the particular challenges that a supply shock can present to a central bank. And that's also raised a lot of questions in academia and in policy circles as to whether or not the inflation process post-pandemic is going to look quite different than prior. Jay, maybe we can start with you. A number of folks have argued that we are entering a new period where
I don't know.
supply shocks
I really don't
will
know,
be
Trace.
more frequent.
Technically, we're in a breakout.
Would love to hear your views
see more
on
ups.
Whether you think that's a possibility and what that might mean for central banks.
So it's a great question, and it's one I think we'll be dealing with for quite a long time. And I'd say it's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence. As Yogi Berra is thought to have said, Ben, you're the baseball expert, you can confirm or deny this, but it is difficult to make predictions, especially about the future. So I think that the best we can do at this stage is probably to just identify the factors that we think can lead to further negative supply shocks. I will say that, though, that positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks to the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially
Wall's down
or
7% on
fully
this.
halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now.
Close, maybe. Well,
but for policymakers, the bottom line is that central banks will continue to be
I don't think
responsible for
BBBYQ
providing
the
price stability, and that will require us to navigate whatever
I've not really seen it
supply
on it.
shocks do occur.
Kind of joke about it some,
as
but
Tomas and Ben and their co-authors
think it
wrote
really
in the
does have it.
inflation targeting book, what a central bank can do is control inflation. And that is true over time, even in the presence of supply shocks, should they come.
Ben, I'd love to hear your views on this.
So unusual events which disrupt normal economic functioning often are followed by inflation. Examples are World War I, World War II, the Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. And in particular, the pandemic scrambled the labor market, made it harder to judge the state of the labor market. The opening led to a very extended rise in commodity prices, which was difficult to deal with. We had supply chain issues, which was pretty much a new thing, which was also a contributor to inflation. So there are many features of the pandemic that made this an unusual episode and a difficult episode to address. That being said, I think that, and I've done some research on this with Olivier Blanchard that we're presenting next week, the basic mechanisms, I think, are still the same. But you have a bunch of bad shocks, that's going to give you a problem. But the underlying mechanisms of supply shocks and tight labor markets and so on are really the same. So I think, I don't think there's been a major change in the underlying process that generates inflation, only a series of shocks related to the pandemic that gave us this episode. Going forward, I agree with Jay that we can't predict, what new shocks will come. We've got new technologies out there that might, make big changes in our economy. We've got, green investment, things like that might affect the price and availability of fossil fuels. And so there are many, many things that we can't predict. But I think that broadly speaking that the inflation process has not changed, and it's one aspect of that, which is very good news, is that the Federal Reserve's credibility has helped keep inflation expectations, particularly longer-term inflation expectations, reasonably well anchored, which is always sort of the first step in getting control of inflation.
You mentioned the role of the labor market tightness in the inflation process. I think it's quite striking that right on the eve of the pandemic, the unemployment rate was around 3.5%, a 5-decade low. Yet at the same time, inflation was kind of struggling to get up to 2% on a sustained basis. Here we are in 2023. The unemployment rate is roughly at the same level as it was prior to the pandemic, but of course inflation is far above 2%. So in that context, should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is slack really not the key to understanding inflation in the first place? Ben, you want to take that one first?
As I was talking about before, I think that the pandemic, to some extent, scrambled the usual signals from the labor market. And the Federal Reserve over time has begun to put more weight on things like the vacancy to unemployment ratio, which seems to give a better signal in a period of change when the labor market matching process is in change than the unemployment rate. So there has been some scrambling of those signals. That being said, it's simply not true that, even in people who've understood since the 70s that there's not a simple inverse relationship between inflation and unemployment. In particular, what can break that relationship is supply shocks. And so during the 70s, we didn't particularly have tight labor markets most of the time. We had high inflation, because we had oil price shocks, which the Fed did not respond to adequately, B, because inflation expectations were not well anchored, and there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist, but the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021. By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-housing services is showing signs of real persistent. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that would be that an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to have been to signal. I mean, to put some numbers on it, we at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1-to-1 essentially. In 2021, it was 2-to-1. And that was a much better indicator, obviously, at that time of the simple standalone unemployment rate. Although, as I mentioned, you could also think of it as the natural rate being highly elevated. The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to being more responsive to changes in the labor market slack. But the Phillips curve was once thought to be fairly steep after flattening. Relationships in the economy, like the Phillips curve, evolve over time, so I would not characterize that as a problem for our understanding of inflation.
Very good, thank you. Maybe we can pivot here to the topic of central bank communications. It's widely understood now that the better the public understands the conduct of monetary policy, the more effective it will be. But fostering that type of understanding really requires a lot of communications, and of course that can be hard. Both of you have been powerful advocates for advancing monetary policy communications, both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections.
Yeah, it depends on what time frame you get your data from for the beta.
Since the communications revolution began, would you highlight as being
I don't know if there's any metrics that are showing that's negative on
and where does some
barbecue.
remaining challenges exist?
Well, when you talk about communication,
That guy's Bernanke.
you need to understand
also
that
on the
it serves
Fed.
multiple purposes. I mean, one of its purposes, the narrow purpose, is to try to align market expectations with the Fed's own thinking. I think that goes back to Alan Greenspan. If you go back to 1994, the first FOMC statement. I mean,
I don't know, Jose. I mean, a lot of it's
the Fed has
speculation.
tried at least to give some indication.
You can look at like interested parties on the filings.
It sees as the risks to the economy. But beyond that, you mentioned transparency and accountability.
Those people that are interested
This
in
is
it.
a powerful institution. It's very important that it be accountable
But
to the
that doesn't mean
Congress
it's
and to
gonna
the
be
public. And best way to
bullish
do that
for
is explain
shareholders.
what we think, what we're doing, and how we're going to go about that. There's other reasons for communication. One I would talk about is feedback. We're having a conference here. If the Fed puts out the issues that it's concerned about, economists will write articles or tweet and respond to that. Or in the case of the Fed Listens program, maybe it would be more ordinary people who are explaining how monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture, and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times a year after the Summary of Economic Projections, in which Chair Powell has taken to an art form. And I think also, just the inflation target, the forecasts that we release, and there's a cultural change, which some people don't like, but I think on net is good, which is, it used to be, if you look back at speeches in the Greenspan era, the president of the Federal Reserve Bank of Minneapolis, would talk about, harvests or something, wouldn't talk very much about the global or national economy. Now you have a lot of people talking about, the different aspects of the Federal Reserve's views. And again, that contributes to both market transparency and also to accountability to the local constituency and to the national constituency.
Jay, you of
Flag
course
coming
have
down a little
continued
bit
to
there.
push forward on the communications and transparency fronts. Welcome your thoughts.
You know, I think the broader setting is that transparency is especially important today. Polling data show that many important public and private institutions globally have struggled to retain the public's trust and support in recent years. Now, we're an institution that serves a critical public mission, but to be here and work here is to know that the particulars of what we do and how we do it are not generally top of mind for most people. And on top of that, we have a critical and a rare grant of independence. And all of that, to me, means that we have a special obligation to explain ourselves clearly, what we do, why we do it, to provide transparency to the public and their elected representatives in Congress so that we can earn and deserve their trust and support. And that's a critical task if we are going to sustain our democratic legitimacy through this interesting period. My colleagues and I really take that as a primary and affirmative, proactive obligation and not something we see as a burden or of second-order importance. So in that spirit, to your point, we have followed the example of Chairman Greenspan beginning in 1994 with the first post-meeting statement, through Ben's innovations and Janet as well, in looking to foster greater transparency and accountability. And a couple of examples, we now do a press conference after every meeting, not just every other one. We have greatly expanded our congressional outreach to be certain that we hear directly from lawmakers on an ongoing basis, so that they have the information that they need to conduct appropriate oversight. As I mentioned, in 2019 and 20, we conducted a public review of our monetary policy framework, seeking input from a broad range of people and groups all around the country. We've also significantly expanded transparency beyond monetary policy. For example, we now publish semi-annual financial stability and supervision and regulation reports. Of course, there are always communication challenges, especially I find about communicating the uncertainty that attends our assessments of economic conditions and the outlook. The good example of this is, despite our persistent efforts to explain otherwise, the policy paths from the SEP seem regularly to be taken as a firm plan or a committee decision, rather than what they are, which is a compilation of individual participants' best assessments on a particular day of appropriate policy under the assumption that conditions evolve in line with their baseline forecasts. So that's just a challenge that we constantly face in the context of great uncertainty. Despite that, I would say, though, that the summary of economic projections has actually been very useful during this tightening cycle, as markets have looked ahead and priced in future rate hikes, long before they're actually implemented.
Your last point really brings up the idea of communications as being an effective policy tool. And I guess the key element of that is the use of forward guidance. Jay, in one school of thought, forward guidance is a tool that should really only be deployed when interest rates are at the effective lower bound. And so you can no longer provide accommodation by lowering rates further, and so you do so through communicating about the policy path.
We'll see support from yesterday's high.
But another school of thought, forward guidance should be just a regular part of communicating with the public to convey the committee's policy intentions, even far away from the effective lower bound. Where do you come out in that debate?
Well, I do think it depends on circumstances. I do think that forward guidance can be useful when policymakers have a materially different or clearer view of the likely path of policy than does the interested public. I would agree at the effective lower bound when we need to provide more stimulus by indicating an intent to keep policy accommodative longer than the public expects. There's a use case there. I also would say, though, that communication comes with a cost of misinterpretation, and it also may limit flexibility. So I think we should use forward guidance sparingly when the course of policy is either reasonably well understood or, on the contrary, is so dependent on uncertain future developments that little really can be said constructively about the future. And a good example of that was the March 2020 FOMC meeting. The pandemic shutdowns were just beginning. The level of certainty was almost unimaginable, and we chose not to issue an SEP at that point. Really, our view was that releasing a forecast at that time might have been more of an obstacle to clear communication than a help. In contrast, as I mentioned a minute ago, forward guidance has really been a useful and effective tool during the current tightening cycle, as financial conditions have tightened well in advance of actual rate increases. The 2-year tightened between the September 21 meeting and liftoff in March of 20, it tightened by 200 basis points before we ever actually lifted rates.
He's confirming how he just needs to hint at stuff in the market.
So
we'll start to price it in,
until
so he doesn't always have to even follow through with it.
That further policy firming would be warranted, and our forward guidance has said so.
He likes that.
Now, however, we've come a long way in policy tightening, and the stance of policy is restrictive. And we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. So today, our guidance is limited to identifying the factors we'll be monitoring as we assess the extent to which additional policy firming may be appropriate to return inflation to 2% over time. As I noted at the last press conference, that assessment will be an ongoing one as we move ahead, meeting by meeting. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
Thank you. Jay, you mentioned that guidance can be useful at times when the public may expect a very different policy path than policymakers. How do you think about those sorts of situations?
You're right. So recently it has sometimes been the case that markets appear to be pricing in a different rate path than the committee expects will be appropriate. But I would say that disconnect does not seem to reflect a misunderstanding of our reaction function or a lack of belief that we'll do what's necessary to bring inflation down. Rather, it appears to reflect simply a different forecast, one in which inflation comes down much more quickly than the committee participants think is most likely, perhaps due to a significant downturn. I would say also, so far the data have continued to support the committee's view that bringing inflation down will take some time. Moreover, something we often don't remember to think about is that market prices always reflect both expectations and compensation for risk. And what market participants say in surveys of their expectations is actually closer to the views in the SEP than what is reflected in market pricing. So ultimately, my colleagues and I have our forecasts and market participants have theirs. Our role is not to advocate for our forecast. What we can do is be clear about our expectations for growth, unemployment, and inflation, and the likely implications for policy. As well, we want the public to understand how policy would react if the path of the economy were to differ materially from our expectations. And of course, we do lay out our individual forecasts quarterly.
Ben, what would your takeaways be for the past couple of decades' use of forward guidance as a policy tool?
Well, Charlie Evans and co-authors have made a useful distinction between what they call Odyssean and Delphic forward guidance. Odyssean forward guidance is a commitment forward guidance, which is rarely used, but typically at the lower bound, where the central bank promises to do something, and its credibility on the line, that it will follow a certain path going forward, and that's a way of getting more stimulus. And I think, again, that goes back, again, to Alan Greenspan, I think, to indicate that a certain path was very likely, and that actually helps achieve the objectives. Delphic forward guidance is basically just a forecast. Here's what we think. Tomorrow we might think something different, but we're just trying to, as part of our transparency, we're just trying to give you a sense of where the economy's going and how we think policy will react. Now, as Jay points out, there are some problems in practice. One is people don't understand the difference all the time between a commitment and a forecast. That's something that Jay has emphasized, and I think that should be emphasized. Another is people underestimate the amount of uncertainty involved, which is enormous. So I don't think you can do without some form of forward guidance, because the idea of transparency says, here's what we see, and here's why we're thinking. And so the idea that there's no guidance at all, most of the time, I take March 2020 as a counterexample, but most of the time you do want to give at least a sense of where you think the economy and accordingly policy are heading. I think, just if I might editorialize one more minute, I think one of the issues is that the FOMC is so large and geographically dispersed that it's been difficult to come up with a collective committee forecast. We tried to do that when I was chair. The dot plot is a compromise, which is not ideal. Other central banks do other things. Sometimes they have collective committee forecasts that are voted on, or they use market rates, or they publish the staff forecast. So there are different ways to go about this. But again, I think that forward guidance is both an instrumental tool But again, letting people know sort of how the central bank sees the evolving situation, even if there's lots of uncertainty, which you can say, normally is part of transparency.
So you highlighted uncertainty as being a key factor in dealing with some of these issues. Obviously, uncertainty is a pervasive feature of monetary policy making, and often invokes the so-called risk management approach to making monetary policy. Maybe we can start, Jay, with you on this topic. The FOMC's raised the federal funds rate by 5 percentage points in a little more than a year. That's a very rapid pace by historical standards, as we all know. How do you view those actions in the context of the uncertainties that you and the committee faced about the economic outlook, and how did risk management considerations factor into your decisions?
So I'll start by remembering that Alan Greenspan famously said that pervasive uncertainty was the defining characteristic of the policy landscape. It's worth remembering that he made that comment during what we now think of as the Great Moderation. So that statement has never been more apt than it is today. If you look back, the pandemic, the global shutdown, the historically forceful response and the reopening, all of that had no modern precedent. So it has been a time of historically elevated uncertainty and of unexpected outcomes. No advanced economy had ever faced a shutdown and a reopening, and now all of them would face it at the same time. So no matter what happened, the outcome was going to be unprecedented. So this level of uncertainty posed real challenges for policy and policy communications. On the one hand, we had to be nimble to be able to respond to the evolving situation. On the other hand, we wanted to be as clear as possible about what we were doing, lest we add to uncertainty. So I would say policy certainly has been nimble, consistent with what within our expectations. The data did actually show declining inflation through September of 2021, but then turned decisively against that expectations thereafter. And in response, we accelerated our policy firming, ultimately, as you noted, raising rates by 500 basis points in just over a year. Over this period, we communicated that the object was to reach a stance of policy that is sufficiently restrictive to return inflation to 2% over time. But we also communicated that the level of rates that would ultimately be required was highly uncertain. Now, until very recently, it's been clear that further policy firming would be required. As policy has become more restricted, the risks of doing too much versus doing too little are becoming more balanced, and our policy has adjusted to reflect that fact. So we haven't made any decisions about the extent to which additional policy firming will be appropriate, but given how far we've come, as I noted, we can afford to look at the data and the evolving outlook and make careful assessments.
Ben, when you became a policymaker, you were well versed in sort of the academic literature on decision making.
Yeah, I moved from that side to this side.
Yeah. How does it work in practice?
I say uncertainty when you're an academic is trying to decide whether your error term is Gaussian or not. In actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was sitting just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later it turned out that inflation change had been revised away. And I asked the chair, do you think we can revise our interest rate policy? It is very difficult. I mean, got to laugh with that, but just trying to make policy, it involves not just uncertainty about, the data, about the model, about all the things that can happen, about the social and economic and political environment. So it's very difficult, and unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and do the best you can, being ready to adjust as new information arrives.
Very good, thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, or most prior cycles. So that's going to be a question that we will resolve empirically, but I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was very, at the beginning, very focused on the goods sector due to the rotation of demand from services to goods, and the tremendous amount of support that goods purchases got from fiscal and monetary stimulus. How did it spread then through really into the service sector, where it now significantly resides? I think we're seeing much progress on goods, and we have progress in the pipeline on housing services, but where we see persistent inflation is now in the service sector. So what is the mechanism by which that happens, and what are the implications?
Ben, you have the last word.
Well, I think one of the things that I would urge researchers to look at is the relationship between monetary policy and financial stability. A very, very difficult relationship. If you read the papers, you see that everybody has a very strong opinion about this subject, but they don't necessarily correlate. As Mark Twain once said, the things you don't know can hurt you as much as the things that you know for sure but ain't so. You know, I think that we really do not understand, to the extent that we need to, the relationship between different aspects of monetary policy, risk-taking, balance sheet behavior, et cetera. It's just something, there's a lot of good work being done, don't get me wrong, but I think we need to understand much better what the channels are, and to quantify the relationship so that we can think about to what extent we need to take that into account in monetary policy.
Very good. Well, let me thank both of you tremendously for sharing your perspectives with us today. It's been a highlight of our conference honoring Thomas Lobach, and so thank you very much. Round of applause.
Meeting is adjourned. We bounced around Spy. Oh, I'm definitely need copyright for that song. Is the rally back on or what? Maybe. GME bounced right on that support level we had there. Back west still kind of hanging the lows. Wall, same deal. Didn't have the same bounce that SPY did. Barbecue down 3%, 1753. I see it hold that 17 level or 1750. Might not. We'll see. Get some highlights from what at the meeting, what he said. Nvidia is now trading at 29 times sales and 182 times earnings. Debt limit talks hit roadblock as GOP negotiators walk out. Just 20% of financial services companies require full-time office work or full-time in-office work. We'll look at some PAL highlights. Recently has been the case that markets are pricing a different rate path. So far, data seem to support the committee's view that it will take time to lower inflation. We can afford to look at data and ongoing outlook. Debt ceiling talks between White House and House Republicans have been paused. Market's not really responding to that, doesn't seem like. It's all from Powell. Powell has said, have not made any decisions about whether the rates are sufficiently restrictive. Well, that's pretty hawkish. We're at an impasse. Source involved in debt talks says, not one issue, but multiple issues have been proven problematic in debt ceiling talks. What are they pricing it now? Fed funds futures. Really looks like the SPY is still in this channel, holding above that 9 moving average. Not liking it for the bears. SMX came back down. Alt green 5%. I'm getting a little poppy right now. Oh, GME hanging out at the lows. Down 3.9%. Down 4%. Up on 12 o'clock. It's still really early.
She's saving a lot less, and she needs to go to places that are convenient and offer great value. And Walmart is a great option for that. The other one's Dollar General, and I mentioned the 2-year stack performance that Walmart generated, which was about 4% during 08-09. Well, Dollar General was close to 20, and that's a business that operates in many rural markets in the U.S. that are composed in towns that have 5,000 people with one stoplight and one general store, and maybe it's Dollar General, and many of these other customers that are living within those areas don't have an option to go to that's convenient with great value. So Dollar General, as an example, has prices that are 40% below convenience stores, 20% below traditional grocery stores, and at parity with or within a low single-digit range of retailers like Walmart. So you can do your big weekly shop at Walmart, and then you can do your fill-in shop at Dollar General. So these are two retailers that I think that are really well positioned into a potential recession ahead.
All right, hence the buy rating. Walmart buy rating 175 from Corey at Jefferies, and Dollar General buy rating 285 price target. Appreciate those picks, and for both of you for breaking it down for us. Corey Tarlow, equity analyst at Jefferies, and Lee Bull of Charles Schwab.
I made it back up to VWAP, but it's
going to do it for Trading 360. I'm
kind of weak still.
I'll see you at 2 p.m. Eastern for the watch list, but stay tuned because Fast Market is up next.
This is like a triple top, kind of
you're an experienced investor
into taper potentially.
TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis.
Yeah, GME's fallen below that level. Down 4 1/4. 22 bucks. On April 13th, 2021, and Kramer said, "We like Coinbase," to 475. This week he said, "I'm not a believer in Coinbase." Coinbase is down 82% since then. Oh, rawr. GME 4.25 down. Tesla's holding up pretty well, up 1.2. GME getting red candles here, 2202. Barbecue, little wick up there. 1804.
You either actively seeking employment or enrolled in an education program. So those are the four things. Couple seem very easy. The spending caps and the work requirements, that might not be real popular, Tom. So this is going to be interesting next couple days, but it sounds like it's not in a crisis. They just paused for a little while, but it didn't sound great either.
Yeah, and I noticed that Powell was actually reading off of notes, so he's playing middle of the road at this point. We did take a little bit of a hit when he started mentioning the job and labor force. That might be the next, shoe to drop, which would actually cause inflation to come back down toward their 2% preferred level at this point. So maybe some more pain needed for the jobs market, because that is still robust and solid. All right, Kev, one of the stocks leading the Dow down today is Disney. Got a downgrade out of Macquarie earlier today. Let's bring in Jenny Mahorn, markets correspondent here on the network, to help us break this down.
Yeah, we're seeing Disney shares lower. It doesn't seem like new sentiment here, as it feels like the analyst community feels this could be one of the more unhappy places on earth, as shares have shed about this month following that really lackluster second quarter update from the company. Now, the analyst today from Macquarie is downgrading shares here to neutral from outperform, while also cutting its price target to $103 a share, down from $125. But I have to say that a lot of the sentiment that is echoed from this analyst is stuff that we already pretty much got after that second quarter print. They said they see near-term uncertainties weighing on Disney's earnings valuation and investor sentiment. Linear networks are deteriorating. Direct-to-consumer, they said, is a work in progress, with the biggest decision and execution on ESPN still ahead, and Parks growth is slowing. Of course, that follows news we got earlier this week. They will be scrapping plans for that $1 billion facility in Florida amid some turmoil with, of course, DeSantis. So they also said as a result, they believe the shares will be more range-bound for now. And really, we've seen now progress is still underway, though, for a lot of their cost-cutting measures, which you'd think would be seen as a positive from the street. We actually got reports that they will start now taking off some of their more popular titles from their Disney Plus platform starting as early as next week. We first got reports of this last week out of Vulture, who reported they will be removing at least 27 titles. This is, again, in an effort to reduce some costs, as they did highlight this on their conference call with analysts in the second quarter, saying their CFO actually said
barbecue
content here
green
to align with strategic changes as well as their approach to now content curation. But they do expect to see a material impact from removing some of these titles, between about 1.5 and 1.8 billion as a result. And I have to say, I was looking at some of the titles that are getting removed. It's not necessarily anything I think that you would be missing. Willow was one. The movie goes on and on. So I think
GME down 4.6.
there that this is not necessarily the worst news ever if it's titles you won't even be missing.
Jen, when I look at what Disney's doing, you know, I say this all the time, I'm a big proponent of watching the news flow, right? The stream of news coming out in a name. And the news in Disney is all negative right now. They have very little positive news coming up. Now, removing shows from the streaming network, we knew
a little
that
concerned
Bob
with
Iger,
charge
if he couldn't
point.
get the revenue up, is going to start looking
Their
at
earnings
the expense part.
beats.
And paying and reducing shows is
Should
just
be
part of
level
reducing
bounces on.
expenses. I think that, you know, this Florida thing, it's probably a little bit of
Pretty
both,
overvalued, though.
right? It's also reducing expenses, and it's also a little bit of the political fight. But the headlines,
Dang.
the news flow on Disney, Jenny, is just not very positive. Not surprising that it got a downgrade today, Jen.
Yeah, and Kevin, I feel like there's this pile-on effect right now with Disney, because when you looked at actually its second quarter numbers, objectively, they weren't that weak. It was all things focused on those Disney Plus subscribers and the fact that they don't have a clear path to profitability for their streaming segment. So that has just, now we've seen so many analysts react, it sort of feels like a trickle-down effect. Although I will say there's value to reading the entirety of these analyst notes, because this Macquarie analyst did say that despite the downgrade today and these short-term headwinds, they still see their long-term picture and the long-term potential for Disney completely intact. So I think that's also a really important takeaway here if you're looking to invest in Disney.
And a little flush on barbecue. Back to 1756.
Definitely skews
Down
to the buy
2.7.
side here. We're just seeing now some more updated valuation and updated price targets to reflect that. So I think near-term pain for long-term gain with Disney.
Well, it might be longer term than you think. He keeps on fighting with that governor down there. The company does. I don't think that's going to resolve itself anytime soon, but we'll have to wait and see on that. All right, thanks to Jenny Horn, markets correspondent here on the network, breaking down the Disney downgrade. But now let's bring in Joe Mazzola, director of
spot for
Trading and
GME.
Education at Charles Schwab.
Diamond hard.
Joe, welcome back to the show.
UBX5 pushing. The dollar's still kind of rallying.
The NASDAQ 100
Market's been kind of detached from the dollar. Oh, it's sold off during his speech.
In a bearish perspective, you know, some are born to sing the blues, I think, in this particular sector, because it seems like it's overbought at this point, but it doesn't seem to matter to markets, even though we're getting a small pullback today.
Anybody in particular on this set? Is that what you're inferring here, or what? No, I mean,
possibly.
Look, I think, my personal opinion is that at this point, there's a little bit of that FOMO trade going on. One of the things that I've been looking at is the NASDAQ 100 call volume. Just because when you start to kind of get to the top of the range where we're at, I mean, we've seen these RSIs stretched a bit. We've seen a lot of the mega caps, a lot of them are up 30% year to date. Then you look at, NVIDIA and you look at Meta, and they doubled. And so what happens is you get to that point, and a lot of these stocks have already had their moves, and then you start seeing more call volume buying coming in at this point. It's just at some point, there's a mean reversion that occurs in the market. It doesn't mean it has to at this point. It's just something to be aware of. Be a little bit more cautious up here, because when we start to see the moves to the extent that we have, and then we start to see some of that volume, especially like I said on the call side, where you're getting people long stock, long calls. Everybody's got the same trade on. People are piling into the mega cap names, and when you see things like that, like I said, it's a bit of a yellow warning flag.
Yeah, and Joe, I kind of wanted to bring this up to you because I read some of your notes, and it states like, there's been beaten down sectors of the market. Remember, the rally that we've seen in the S&P 500 has been based on the back of about 10 different stocks, 5 to 10 different stocks. If you look at a one-year chart of the equal weighted S&P 500 versus the SPX, it's diverged at levels that we haven't seen for years. Is that a warning flag? Either, that maybe some of these names are going to play catch up, or we're going to see some of these big cap techs maybe take a hit and pull back here.
Well, I think that's what you brought up, Tom, is a great point. It's that it doesn't necessarily mean that the market has to go down, but what it means is that a rotation might occur, right? I mean, just look at the difference in terms of the year-to-date of the NASDAQ versus the S&P 500. It's almost 3 times, right? I mean, in terms of their performance, I think it's 22% up on the NASDAQ and around 8% and change on the S&P. So it doesn't necessarily mean that the market as a whole has to fall, but what it means is you might start to see some of that rotation into some of these underperforming sectors. And as an investor, I think that makes a lot of sense. You've had some of that outperformance in some of these mega cap names. Why not, shift your chips a little bit into some of the other things, no pun intended, right? Yeah. But into some of the other names that have underperformed. And that way, even if the market does continue to go up, you don't feel like you're missing out. What you do now is you're kind of rotating that money to take advantage of that mean reversion should it occur.
Yeah, and equal weight S&P 500 up less than 1% so far this year. The S&P 500 up 9% so far this year. But Kev, when you look at some of the asset classes that we've been focusing on this week, the dollar index just pulling back here today from 8-week highs, just slightly. We've got yields near that 3.7% level on the 10-year. That's basically about 2-month highs on that one. It should signal maybe markets are getting a little ahead of itself at this point.
Last comment on the NASDAQ. When a major index like the NASDAQ 100, when its chart looks like a biotech stock, I think everyone should be slightly concerned because that chart on the NASDAQ is pretty incredible. Now, back to what we were talking about, the fundamentals of this market. Yields now approaching 3.7%. The dollar, though down today, actually has been strong up until now. Having a soft day today, if I look back at the notes of things we talked about, I think some of that is, the relationship between some of the other Fed speakers and what they're doing. And actually, John Williams this morning talking about this the long-term interest rate that he thinks might be lower for longer, the long-term interest rates. He thinks although interest rates are high now, I thought that was a real interesting discussion, and I think that made the U.S. dollar break. So the market's getting a little bit of relief in the lower U.S. dollar, but still, they've had a strong run, and yields continue, Tom, to march on the upside. So, remember, I love to look at crude oil, the dollar, and yields. Two of them are down right now, even though crude oil is relatively unchanged, but yields are still on the march, Tom.
Yeah, not causing too many headwinds, the higher dollar and higher yield so far this week, Joe. But when you, take a look at, the expectations of a rate hike in June, right before Fed Chair Powell came on air, it was about 40% probability.
Getting back to this, testing this level again.
To come down. He sounded a little bit more dovish than that. But when you look at the negotiations on the debt ceiling, it seems like the market's already priced in maybe a good outcome on that side. Is that what you're anticipating at this point?
I mean, think about all the things that the market's priced in.
One of the highs from yesterday.
That are good outcomes going towards the end.
See if we're making a head and shoulders here.
the debt ceiling negotiations, but they're pricing in cuts to the interest rates and pricing in earnings growth in the second half of the year. Because like I said, when you see everybody on one side of the trade at that point, as a trader, specifically as a trader, you know, I tend to look at what can I do to maybe hedge some of that risk should that not occur, because if that's the case, you're going to start to see all those people that piled in are all going to have to get out at the same time. You know, the thing with the debt ceiling is you hope, right? You hope cooler heads prevail, it gets done. But how much of that is already priced in? I think that's what you kind of need to look at this point, especially when we talked about, you know, should things not go the way of the interest rate cuts, should things not go the way of a profit expansion.
Good bounce on the SPY there.
What does that mean for that 22% rally that we've already seen in the Nasdaq? Now, I think you need to put that in a frame of reference, right? Given what we saw last year in 2022.
Wall made it back up to VWAP.
I think that makes sense, but I think when you get to a certain point where things get a bit stretched and you're trading
so far similar to what did yesterday. That big rally in the morning, came down, bounced off the previous day's high right here, and ripped. But this isn't yesterday's high. This is a level from yesterday.
Down 0.6%. What, 13 months in a row?
And this was pretty flat at open.
Strong macro environment right now. If anything, it's showing a slowing in the economy. It's not a panic by any means, but they're showing some slowness. But we also see a market that is kind of forward-looking, and I think the market is pricing.
I think the rally might continue next week, though. I don't know.
If we can look 6 to 9 months forward, things should be turning around and moving in the right direction. I'm not so sanguine myself.
Yeah, and
hold these shorts or
a quarter
flip.
basis point hike are cut in half, only about 20% at this point. Rate cuts is still expected. Fed Chair Powell kind of hinted on that during some of his commentary that they don't have cuts planned at all. The markets are kind of differing on their opinion on that. We'll have to wait and see. All right, guys, let's take a quick break, but we're going to extend this conversation on big tech here. We're going to look at Netflix, which has given up a bit of yesterday's 9% rally, but still a solid year for this company. Fast Markets coming right back.
The share of new mortgages with an amortization period longer than 25 years in Canada rose to 46% from 41% over the last year. Fed Fund futures, 14% probability of a June 25 basis point rate hike. I feel like it was it higher before the meeting? If I can find that. You guys remember, was it higher than that? I think it's calmed down. Florida has built as many housing units as the UK in 2021, despite having a population 1/3 the size. I'm gonna say I think Canada's shorter because longer than 25 years. I mean, our standard's 30. Seems like maybe theirs are normally shorter. What do you Canadians do? Do more 15-year or 20-year?
From the regular membership, so all positive here with clearly the leader in streaming as the dust starts to settle on this sector.
Yeah, that's a great point, Kev. Joe, I'll bring it back in here.
Barbecue back to green.
Competition in the streaming space. I mean, we've got Disney. They're actually dropping content now. They're not going to put money into it. You look at some of the moves in Paramount,
more arms.
Warner Brothers Discovery. Those stocks have been beaten down while NASDAQ continues to do pretty well. And now, you know, they throw in this ad tier and they're
adjustable
get rid
rate
of password sharing. It looks pretty decent for Netflix. Maybe it's warranted, this rally we've seen, right?
Yeah, especially when you look at that 3-year chart, as you were showing, right? I mean, you know, on a one-year basis, you hear the word double, and you know, it causes a little bit of consternation, right? But when you look back to kind of where this thing has come from, it makes a lot of sense. I mean, look, Netflix itself, as you guys mentioned, it is, you know, it is the 800-pound gorilla in the streaming service, and it doesn't seem to be slowing down. If anything, this new ad tier business model that they're rolling out is going to, and has been, you know, creating more growth.
Barbecue plus 1%, 18.25.
Password sharing. I mean, that's a big deal, and a lot of the data around some of the studies that they've shown is that most users are okay with that, right? They don't mind paying the $6.99 with a 30-second ad at the beginning or at the end of whatever video they're watching. That's not a big deal for them for that price point. Now, especially on a valuation level, right now it's trading below its price to earnings and price to sale 5-year average, and the enterprise value to EBITDA is around 8.5, and you know, those are all pretty attractive levels. So when you see my trade, you're going to hear all this and you're going to say, well, wait a minute, that's a bearish trade. It's not really a bearish trade. It's bearish in the interim, but if we want to get to that, I can explain my thoughts behind the trade.
Yeah, let's go over this example trade. I like when we look at different types of strategies where you think it might be set up for something directionally, but at the same time, it can be neutral too, right?
Yeah, so basically this trade is the June 16th expiration. The 360, 345, put 1/2. So basically I'm buying one of the 360s, selling 2 of the 345s. Should be able to do that around a 90-cent credit. Now, on the surface, absolutely, that looks like a bearish trade. What this trade is trying to do is it's trying to take advantage of a couple things. Number one, the 10% move in a day. You know, looking to maybe come back and fill that gap, take it back down to maybe that 345 level, 48 and change, which was resistance prior to that big move that we saw yesterday. Should you get some kind of a gap consolidation, this position will expand in value. It's not necessarily a take on Netflix, as more as it's a take on the NASDAQ as a whole, and the moves that we've seen in the mega caps. Netflix is not going to be immune to a potential pullback in the NASDAQ, but given the fact that, you know, its valuations are fairly in line with what and better than what we've seen on a 5-year average, it can maybe hold, potentially hold this range a little bit better than
barbecue.
what we might see with some of the other names.
Well, there's not more that I want to sell.
Some pretty big moves.
It looks like it might rally without me selling.
I will say this.
I mean, that would be preferable, I guess.
Also taking advantage
for me.
Of the skew that we're starting to see right now in Netflix, where with a lot of the NASDAQ, you've started to really see kind of a volatility smile, right? Where we talked about everybody's kind of buying up the calls. Well, NASDAQ, you're starting
down 9%.
You're starting to see a little bit of that shift back to the puts. You start to see some hedgers come in, especially after the big move that we saw yesterday. So the put activity is a little bit higher. And so if I'm selling 2 of the options at a higher skew, I can do that as a way
some of that rally.
That purchase of the 360 put. So So the way this thing really works is I've got an embedded.
Don't you put that evil on me, Trace.
360 down to 345, so that's where it maxes out in terms of the gain. And then I also have a short put as a way to kind of finance me buying that put vertical. The break even then pushes out, that extra $15, so it goes from the 345 all the way down to 330. But then I also have that 90-cent credit, so it's actually a little bit below that 330 level. Now, where the real risk is on this trade is should Netflix really start to crater, you have the potential to buy it at 345, and if it really starts to move down past that last area of resistance, which is something I'm looking at as potential support going forward, then this thing becomes basically you own 100 shares and your real risk is all the way down to zero in Netflix.
Yeah, let's break this one down real quick. June 16th monthly calls.
Look at this chart. Lifecore,
28 days till
Biomedical.
expiration. Buying one of the 360 puts, selling two
Kinda
of the
nice
June
looking.
345 puts, 90-cent credit. So even if it stays here or goes higher, you get to keep that credit. Apex of profitability right at that short 345
Let's move
strike
us out
that
of that
you mentioned,
Manhattan
where you
group.
sold two options on
This
with
is the
back
way.
ratio. Break even 10% below the current share price here, Kev, on this one. So you've got to have that capital because the risk is about $32,900 down to zero if the stock were to somehow go down there. We've got to mention that. But Kev, your thoughts?
Yeah, the break even on this, where you would get long Netflix if it moves on the downside, is basically just over $329.
Yeah.
So the trade Joe does, and I like to refer this as like a buy the dip strategy, because if Netflix doesn't go down and moves higher, you collect your credit and you're done, and you actually have a small profit. But indicative of what Joe was talking about the skew on the puts, the fact that he's able to do a $15 wide 1x2 and still for a credit, that shows you how much the out-of-the-money puts are trading, because that is a big vertical that you get to put on for a net credit. And anything in that middle range between 360 and 345, it's one of those scenarios where you put it on for a credit and you take it off for a credit. But it does have downside risk, Tom, as you mentioned. So you have to be ready on the downside there. But like I said, the downside where you would essentially buy Netflix, about 329 and some change, Tom.
Yep, and you've got a
Like
month
it's about
in
to
this
reverse.
trade, and the stock starts to
Yeah, I
creep
like this
lower,
menu
maybe,
chart.
Tech gets hit a little bit.
An RSI divergence
You have
here.
the ability, if the market's open,
Well,
liquidity
inverted head
provided
and
to
shoulders.
close it out,
In a
if it starts
downtrend,
to
but
expand in price also.
reversal
Yeah, go ahead.
indicators. Active flip
The
bullish.
other thing is, look, we understand that that's a lot of capital to tie up in one trade. Let's say you want to go down and buy maybe the 305 puts. If you do that for about 90 cents to a buck, now you have a butterfly on where you're not collecting a credit, but you've reduced a lot of that capital that you tied into. So you can turn it into a broken wing butterfly if you want and reduce that capital exposure.
Yeah. All right. Great look at a different type of strategy. But if you expect maybe Netflix to maybe grind lower or
Little
even
gap down there.
consolidate, nice look at this strategy.
Buys
All
come
right,
down a
thanks
little
to
bit.
Joe Mazzola, Director
Gold
of
is
Trading and
selling off.
Education at Charles Schwab. for
Gold is
joining
down
us, breaking down
10%.
markets and
Broke
Netflix.
that low.
But coming up after the break, Kevin and I are going to be joined by Megan Brantley from Likefolio for a discussion on NVIDIA, which continues to rally this year.
Yeah,
on the
retail's
back of
going
its
down
AI
today.
potential.
GME down
You heard that
5%.
first here. Potential. Stick around. Fast Markets coming
2188.
right back.
America. Lots of bank. Spies coming down. Buy flushing down here a little bit. Back to the lows of the day. GME down 5.3. 21.79. Barbecue 1801.
Gaming and even blockchain technology. And NVIDIA has a hand in all of these sectors, but I think that the majority of the hype is being driven by this new AI technologies and how NVIDIA is involved here. And, a lot of the large language models that are used to train AI systems like ChatGPT, like Bing's AI bot, they're run on GPU software from NVIDIA. So this is a really good space for NVIDIA to be in. And I think that's where a lot of this optimism is coming from. At least from our data, we're really listening to those consumers who are talking about NVIDIA. So the majority of our mentions are actually driven more from its gaming segment. And so you can see that generic gaming, we do still see a drag here overall in terms of this macro trend. Consumers are talking about gaming even a little bit less than they were last year. But when we look at NVIDIA specifically, we see a lot of traction in its GeForce brand. And a lot of this is from its 4060 series family. I think that those GPUs are set to be released maybe next week, at the end of the month at least. I know it's in May. And we're seeing a lot of chatter start to rise around that. So whenever we look at, NVIDIA mention volume, we actually see that rising, and we look at, demand and purchase intent, consumers who are talking about, getting their hands on that technology. We do see that those purchase intent mentions up by about 17% year over year. So I think it's important to note that, when you look at this chart, when you look at our data is going to lean heavily into that gaming segment. So it's interesting that we're starting to see, maybe some signs of traction here whenever we see demand growth like that. I don't think that it matches the massive run in the stock that we've seen. So whenever we look at a name like NVIDIA, right now our scores are coming out pretty neutral, but I think that the reason they're neutral is because of those macro trends that we're factoring into this scoring, and because of the growth potential that we're seeing here that investors are expecting NVIDIA to capitalize on.
Hello, Megan. Happy Friday. I'm thinking about changing my name to Kevin A.I. Hinks just because I think it's going to help me in some way. I'm not even sure how. But, Megan, I think that NVIDIA is an incredibly popular stock. I just don't know if it's this popular, right? I mean, I don't know if they can ever deliver on the hype that AI is promising. Because let's face it, their earnings last quarter were better, but not great. Their PC demand is still down and not bottoming out yet. We have the valuation. I don't know. 180 PE seems a bit rich for me on any single level that I would think of. But your data, where all our opinions meet your data, Megan, is in the divergence in the consumer price or the consumer purchase intent. that rise in the stock is not followed by the rise in purchase intent. And this is when Folio's data, I think, becomes really important because you're highlighting the divergence between those two numbers. Am I wrong there?
No, you're right. I think that whenever you look at that chart, a divergence is definitely present whenever we see the stock heading one direction. And purchase intent, although it's heading in the same direction, it's not at that meteoric pace that we're registering the change in stock price. But I think that one thing to keep in mind when you look at our data is we're just looking at that gaming sector. And I think it's pretty clear, and even the market knows that that gaming sector is underperforming in relation to its other products like its data center and like its AI chips. I think that's what's really drove the overperformance last quarter that maybe some people weren't expecting. I think it's also important to consider NVIDIA's history. It's been involved in AI or some form of this, high performance computing for decades now. So it's really ahead of the curve, and it's ahead of the curve whenever we compare it versus competitors. When we look at overall mention volume of NVIDIA versus other peers, whether it's AMD, whether it's Intel, NVIDIA mentions comprise about 65% of that volume. So this is the clear leader here, and it's also
maybe double bottoming here on the 5 minute.
So I think that that's really important.
It's going to move back to VWAP.
NVIDIA also has a pretty high happiness.
A little early today, only 12:30.
Comprises a large amount of volume. It's still competitive versus peers with a much smaller amount of volume. So I think that that's important too. And just to consider that, think of how much NVIDIA has grown its data center revenue versus a couple of years ago when it was really much more dependent on things like gaming. So I think if we were looking at NVIDIA as a company and only considering that gaming aspect, then this is completely unjustified and makes zero sense. I think that it makes a little more sense whenever you consider the potential applications on the data side and on the AI side. You can kind of see, where the market's head is at, but agree with you. Whenever we look at our signal, if this was an earnings related event coming up soon, our signal would be about a -17, which for us is still in the neutral band, but it's definitely getting into that overbought territory. So I think that there's definitely a case there. But from a long-term perspective, when we look at that long-term signal, ours is a bit more positive. It's still in the neutral territory, the +10, but for us, it tells us that, there is something to this massive, hope that I think a lot of investors are putting in NVIDIA if NVIDIA can capitalize, or can execute. And I think that's the key point that you're keying into, that NVIDIA still has a lot to prove, that expectations now are really, really high, and it's more than likely, at least in the near term, that they may have trouble besting those expectations because that bar is so high.
Yeah, I think that's AI in general at this point, Megan. But when you look at that, the different silos of revenue generation that this company has, the advancement as far as innovation goes, I know you got a -17 score on this. They got earnings next week, so we'll continue to watch that. I'm sure we'll talk about it more. But when you look at this, is it from the investor side and from the happiness side, it's like you don't want to miss this boat because the total addressable market for this could be in the trillions.
Right. Yeah, whenever we look at this, we actually have NVIDIA in neutral and at a hold. We actually issue some bullish alerts. We have two, one in September and one we doubled down again in January. That bullish alert from September, whenever we thought NVIDIA was really oversold, we're up about 140% since then. And so this is something where, obviously we liked NVIDIA trading a lot more back then and even back in January than we do right here. But we do still see positive signs of traction. We do see some signs of maybe even potential interest in gaming again for NVIDIA. But I think that valuation is definitely something for investors to consider. Like we said, if we're looking for an entry point, we liked it a lot more a couple of months ago than we do right now, but we're not to the point where we're betting against it.
Right. I bet you a lot of investors would like this to kind of turn down so they could probably get into it at better levels. All right, Megan, great stuff as always. Appreciate it.
Thanks, guys.
All right, that's Megan Brantley, Vice President of Research at Folio, breaking down the data. Kev, I wanted to talk about this just because we're talking about big tech today, but just the massive rise in NVIDIA. You and myself as traders down on the floor, we look at charts like this and start licking your chops because you're like, man, this thing can't keep going up. But I probably said that 3 weeks ago or 5 weeks ago also. So, how do you want to look at this from an example trade? Because we do have earnings coming up.
Yeah, I mean, we look at the charts, we look at the valuation. What do I mean by valuation? 180 PE and 30 times sales, Tom. How about this stat? 2 times in the past it's been 30 times sales. The dot-com crash or the dot-com bubble, and during the pandemic, during the crypto bubble. Those are the last 2 times it traded at this valuation. So, does that mean it's going down? I don't know. I have no idea. Can it go higher? Of course it can, Tom. My bet is very passive, but it's a bearish bet, Tom. What I did, I went out a month. So I went out to the June 23rd, actually more than a month, about 5 weeks. I went out to the June 23rd expiration, and then next week, the May 26th expiration, Tom. And I just bought the 290 put calendar, Tom. Paid right around $5 for it. It's trading 505, 495, right around in that range so far today, Tom. But $5 for that. It's collecting a fair amount of theta. There is an earnings event in there. So you're buying this into the earnings event where volatilities overall could expand. So, but Tom, this isn't looking for a major move, just a little back off from this overbought category. And like I said, the stock's down today, but it was down more than this. It hit $309 today, Tom. So it's already rallied $5 today off its lows.
Right, giving up a little bit as the NASDAQ is right now. Kev, let's break this example trade down. Buying one of the June 23rd weekly options. Those expire in 35 days. Buying the 290 put and then selling that same strike in the May 26th weeklies that expire in 7 days, and you'll capture that at earnings event. So we've got some elevated implied volatility. You're paying roughly about a $5 debit. So your break evens are going to be at or near around 266 on the up or on the downside, and about 320 on the upside. That might come in a little bit as we get closer, but still a wide range for this stock to trade in. And Kev, you know, you do have that ability to roll that short option on a week-to-week basis. The at the money 1 week roll today on the 312.5 strike, Kevin, is trading nearly $10 for that credit. So you have that ability to roll your short option if the market's open, liquidity is provided, if you want to manage this trade. But the idea is you're looking for maybe a pullback in the shares, and not a massive one because you still have a wide range for this stock to trade in to remain profitable on this. You do have some assignment risk on that short 290 put that expires in 7 days also. So a good look at just neutral to slightly bearish put calendar here in NVIDIA. All right, Kev, take a quick break here, and then we're going to take a look at another tech company that's done well this year, and that's Salesforce. The customer relationship management company is up about 60% so far this year. Fast Market's coming right back.
The ego on you.
Thank you, Ace, for your gifted membership. Get it, man. Grumpkin was the lucky hype gift. Well done, Grumpkin. Make your way to chat. Come thank Papa Ace for his generosity. The eagle's on you, kitty. Eagle's not on me. I did double bottom there. Maybe a VWAP move. I don't know. I don't know how high this thing can go. On the daily, it still looks bullish. So, Ace with another gifted membership. Thanks, man. Went to Chili Chills. Congratulations. You as well. I'm thank Papa Ace. Do it. There's a little pop on SPY.
The ego on you.
All 46. We heard from Powell. Heard from Jenny. What more can the day bring? Maybe some barbecue ripping. Spy flushing. Median cost of renting an apartment in Manhattan was $4,241 in April. All-time high. We did get Jenny. You missed it, Ace. You missed Jenny. I'm not sure she missed you, though. Oh. Arthur says we can't be spending more money next year. Quit spending money. Can't do it. Russia bans Greenpeace International, labels it an undesirable group. Meanwhile, in Russia, Apple forming head. Yeah, I too, kind of. This is the shoulder, we'll see. Interest result 23rd of April invested. What? What's that you say, Trace? Yeah, SPY's a little ahead of Apple. I'm not sure if I'll be able to hold my short position though. They might liquidate my my futures contracts. I got another margin call today. Not sure why. Maybe it needs time for the funds to settle from the barbecue shares. But what I sold from barbecue should have been enough to maintain margin requirements. I mean, it has been in the past.
In the stock, along with the NASDAQ 100, is the fact that I don't see much M&A talk out of the CEO, Mark Benioff, anymore, just because that's been weighing down on the shares. I think the last few years, some of the last couple of big acquisitions,
He was invested till the bankruptcy filing? How do you know that?
We're looking at as of late, I think it has to do, of course, with the large cap technology names. I mean, Salesforce, market capitalization is like $200 billion, so it fits the bill with the
Glad you made it, Grumpkin.
right now. But you're right. If you look at the progress the company has actually made over the past few years, it's been on a large acquisition spree. It has a history of making large acquisitions. Slack was the most recent large one they made. This was back in 2020, around $28 billion.
Well,
which
TGIF
say is starting to manifest into positive
for me today.
for the bottom line in the company. They're also, of course, deploying Slack-based artificial intelligence.
How about you guys?
And in fact,
not gonna miss this week.
Actually has an artificial
Went
intelligence
good, and then
Einstein that they've actually started to develop many years ago.
So
so
good.
CRM has been in the AI space for
Barbecue's held up pretty nice though.
It really took off from the standpoint of popularity in the media, and of course, from the standpoint of also ChatGPT becoming very ubiquitous and popular and highly used. But at the end of the day, the other acquisitions prior to the pandemic, which have become more accretive, or MuleSoft. That's basically a data analytics platform that was integrated prior to the pandemic, and that's back-end data integration, and of course Tableau, data visualization. And if you think about artificial intelligence, there's going to be a lot of artificial intelligence, and there is for data visualization and visualization graphics, and that's why, of course, NVIDIA has been on a tear this past year, because their graphics chips are going to be in very high demand from the utilization of artificial intelligence. Now, looking
Yeah,
at sales
sideways
floors,
is
you know,
good
one
for
would say, hey, this
the
is a
stock
big
in
breakthrough
OTC in Chapter
over the
11
last year-to-date basis
after
of
it's
59
rallied.
or so percent. But if you look at the
I don't know.
earnings estimates, they've been
There's
rising.
no catalyst.
And in fact, coming up at the end of the month, on the 31st, they're going to be reporting earnings. And if you look deeply, they're expected to report $1.61 in earnings, and that's about 39% higher compared to the same quarter last year at 98 cents, while sales are rather robust, especially for a large integrated company like this in the CRM or customer relations-based platform, which competes with the likes of SAP. The sales are actually at 8.17 billion expected, 10% higher than the
Interested party
7.41
redacted.
last year. So
Talking
estimates
about.
for earnings are about 3.5 times sales for the next quarter, and I looked at the estimates on a forward basis for the next 3 quarters after that, and they're rising. So I think that the stock price is really reflecting of an improving earnings profile quite a bit, and I think it has to do with the acquisitions that have manifested in a better bottom line.
Oh, is that what Trey's was
performance
saying?
of the company. And as of late, they haven't made large acquisitions, and that might be a good thing as they
RC
are
Ventures
still
was
absorbing, digesting, and of course, trying to integrate
invested
those
until the
large
23rd of April.
acquisitions that I mentioned just a moment ago.
Yeah, those earnings coming up at the end of the month are going to be key here. But I like the fact that you pointed out that they did raise fiscal year and quarterly estimates moving forward.
What are you guys reading?
$20 billion share buyback probably doesn't hurt either, but definitely some big gains out of CRM so far this year. Thanks to George Tillis, Senior Markets Correspondent here, breaking down that story for us. Kev, I wanted to look at a trade here. Because the stock has rallied so much, you start looking at technicals. I do when you see a move the way that we have. Now remember, last earnings the stock jumped and then it kind of fell back to the same levels that it had. And then they had their investor day and they pointed out that the activist investor Elliott Management has been calmed a little bit. They took some of their recommendations to heart. They haven't gotten deep into the M&A activity as of late. That's also helped. But AI fits right into their mold. So I wanted to kind of look at a strategy here that takes advantage of the move that we've seen by maybe avoiding the earnings event, but then also maybe capping the stock here because it seems like it's maybe stalled out at this level. So if you have that opinion, this might be a strategy that may
Redacted doesn't necessarily mean he's not interested anymore.
Weekly series
I
here.
don't know why it was
Just 7
redacted
days
though.
till expiration. Just selling a call vertical that's on the upside, slightly out of the money. Selling 215 call, buying the 217.5 strike call. So a $2.50 wide call vertical. Collecting
Maybe he's changed from interested party to buying party.
You've got about $1.90 in risk.
I don't know.
$90 per spread above 217.5. Kev, but when you look at this, you know, it looks like a bearish trade, but it's neutral to bearish. The stock can stay here. It can creep up a little bit. You're still going to be safe. Is that the way you look at this this type of strategy when a stock's been parabolic over the last several months?
Yeah, well, what this simply is a strategy because it's risk defined. You could do this against long shares and take the other side of the market, or you can leave this as a standalone trade and fade this move. It's about 10 delta short, collecting about theoretical theta of about $3 a day, and you don't have much duration on this. So this is simply something that, you know, looks at NVIDIA, looks at how far, or I'm sorry, Salesforce, looked at how far it's run and takes the other side of the trade for about 10 deltas. The risk, if you sell it for 60 cents,
yeah, that's a good point.
it's about $1.90.
It needs to be confidential. Interested party to me is
the credit that you take
that could
in.
be
So,
that's pretty.
this is a
I don't know. It's always pretty broad.
It's a trade
It could be like wants to stay current with what's going on, and I don't know. Not like
so 3 of
as
the
his
4 scenarios.
bid in the
this is a
hat.
profitable trade. The only one it's not a move sharply above $215.
Yep, yeah, and that probability of the 215 strike being out of the money at expiration in the next week, about 70%. So Kevin mentioned that the high probability of success on that one. So a good look at a short call vertical there in CRM. All right, Kev, that's going to do it for you and I today here on Fast Market. But stick around.
Well, I don't think there's
on the
any.
TD Ameritrade Network.
I don't think he's under any limitations to where he couldn't be involved, or you know. So that's all that really matters, I guess. We don't know. If there was some agreement when he sold his shares, like he can't get back in or can't be involved in the future, that would be something to look at. But I don't know of anything like that. No, I sold some yesterday. Days. I'm the one that caused this rip. I sold right here and then it ripped. So I reduced some. Yeah, the trade has kind of died for me. Momentum is slowed. Now it's basically just one exposure for this 0 over hero moment is how I see it. Yeah, I mean you could look at it like that, I guess. It's only half. You're still down overall, but yeah, like I said, the trade is, not to say the TA is not there. Like, it's still bullish looking, but I mean, it doesn't matter a whole lot in OTC with an upcoming event. Just I don't think it does. We had an engulfing candle 3 days ago, which is nice. Kind of a bull flag here too on the daily. The momentum's still there, so might still keep kind of climbing. It's held up well. That's the thing, like, there's not a whole lot of reason to sell as long as it holds up. Unless if you're trying to reduce exposure before, you know, an event. I don't know. I'm not going to read too much into it. Trying to save face. All right. Yeah. Since you're up 2x, you should sell half, make it free. Genius play, genius. Your geniuses. Follow happy money. I guess once we know what's going to happen with it, it's not like there won't be a trade at that point. Still could definitely be a potential trade. I guess the only thing is if it gets into like a suspended state and then resumes trading much higher or something, or lower, which I think could happen in chapter 11 in OTC. I think that's a scenario. But I could be wrong. They could just delist it too. Just stop trading it altogether and go chapter 7. Bankruptcy triggered something in his deal so he could get out of it. Yeah, there could have been some clauses in there. W key, look at that thing. Ripped past the highs. Day cup. Where are the apples going? The right. Might as well sell premium. And it's still, look at this thing, it's still in this trend. So, this is what concerns me about SPY also, it's just in this crazy trend still. I think the rally might continue next week. I'm just too stubborn to trade it that way. I was gonna inquire about Bed Bath & Beyond. Oh, is that right, Alan? And I
expected, another relatively quiet day, but you are going to see reactions to different headlines that come out. So we got confirmation from the White House, nowhere on the debt ceiling yet. We got Jerome Powell saying more of the same, that there's a difference between what the market thinks and what the Fed's actually going to potentially do. And both of those threw a little bit of cold water on a rally that still has us above 4,200. So if we're going to really handicap this week, it is hard not to say that this hasn't been a huge win for the bulls.
And I have to say that just from reading Twitter, reading financial news, and also listening on our network, I think we've sort of outdone the debt ceiling terms. I'm so sick of hearing that concept. So on this show, we'll be taking a break from all things debt ceiling today. We'll be focused on the individual equities. We'll kick things off with our upvote and downvote segment. Following that, we'll chart and trade those upvotes. Our FOMO name is one of those names, of course, hitting new 52-week highs in today's session. That is Apple on all news AI. And then we'll look at Foot Locker making a massive move to the downside after some lackluster earnings. Last but not least, our under 30 name today is DXC Technology, which is actually making a really interesting move. Shares were initially lower in reaction to their fourth quarter, and then have since erased all of those losses on the session.
Yeah, tons to get through. Looking forward to that conversation with George. Foot Locker, obviously. We've talked about some of its uncertainties. Well, those are certainly coming to fruition today with the stock plunging over 25%, losing over a quarter of its value. So we'll break down those numbers later on in the show as well. But we'll obviously table some of the big conversations too around Apple and some of the mega caps for later. Let's do upvote, downvote right now though. Not endorsements, not recommendations. Disney, after we talked about it being around 100 and it didn't hold on to that, it plunged down to about 90, has gone nowhere since.
It really hasn't, and I would say I'm looking at its month-to-date chart, not looking so great ever since that second quarter print, but we did get some analyst news today, specifically Macquarie downgrading shares to neutral from outperform with a reduced price target of $103 a share, which was down from $125, but does still imply upside from where we're currently trading just below $92 a share. They do see some near-term uncertainties weighing on Disney's valuation, as well as its earnings and its overall investor sentiment. They said linear networks are deteriorating and direct-to-consumer is a work in progress, with the biggest decision on ESPN still ahead and its parks growth now slowing. This follows reports we did get yesterday. Disney will be scrapping plans for that $1 billion facility in Florida amid some turmoil with the governor, which, Alex, I choose to not really focus so much on those headlines because I don't necessarily think it impacts Disney's top and bottom line overall, frankly. But now, as a result, this firm does see that shares will be range-bound for now. We also did get reports that Disney will be removing some of its titles from Disney Plus as well as Hulu starting as early as next week. 27 titles initially that said they will adjust accordingly now moving forward. This is seen as an effort to help reduce costs, and actually their CFO highlighted these plans on their earnings calls and said it could reduce some expenses by up to $1.5 to $1.8 billion. So that's a step in the positive direction. I was actually reading the titles that are going away. I don't think there are any that you'll necessarily miss, but it does feel like overall sentiment in Disney has taken a turn here. A lot of negativity in Disney, even though all in all, the analyst price target on average still implies some upside from current levels.
Yeah, and in this particular analyst case, Jenny, I think that you should just take it for the what they actually say they see happening. They have a neutral approach with a 103 price target. Well, the stock's at 90, so we know that implies like a 10 to 15% upside move from here. But they're saying neutral. It's basically like, don't run for the hills if you're in this, but also don't chase into this stock either. At the same time, maybe they see other opportunities elsewhere that they perceive as better. But with the stock price target at 103 and the current share price around 90, still to me seems relatively bullish, or at least relatively optimistic. Going to say upvote for Disney. We haven't really looked at this one post earnings. Hasn't done a ton, but making a little bit of headlines today. Next on the list is a name we talk about basically every show, if not every other, and that's Tesla.
And Tesla's quietly having a really nice week with shares up about 7% now to close out this week. And we saw some more bullish really price targets today from Deutsche Bank here with a buy rating while maintaining their price target of around $200, which does imply about $20 of upside from where we're currently trading. But this follows Tesla hosting investors in Austin for for a guided tour of their Texas Giga plant. Analysts were once again impressed with this plant, which they said is well designed and runs very efficiently, and is clearly making good progress in ramping up its vehicle and battery cells volumes, as well as installing tools for the Cybertruck. Tesla did state these developments are expected to lead to some cost reductions, with benefits such as the reduction of expenses that are associated with its initial factory setup, as well as decreased raw material prices and the utilization of the IRA credits. At the same time, though, the analysts did reiterate this environment could get more challenging over the next 12 months. But the company does really remain committed to growing their volume and generating this positive free cash flow. They said they worry that Tesla will really have to take additional price cuts in this weakening environment, but overall are encouraged by the combined unit volume of about 5 million, and say they remain bullish on the opportunity that's presented now with their next generation platform. So while they do admit some of the woes of Tesla, not necessarily anything new here, overwhelmingly positive here from Deutsche Bank today.
Yeah, I'm going to say downvote for Tesla just for the sake of talking about names that we don't talk about as often. You could make an argument every single day that this should be the centerpiece of the show. It's such an important name to the market from a trading standpoint, from a sentiment standpoint, from an interest standpoint. But the stock's actually outperforming here today, up about 1 3/4%. But for Tesla, you could almost make an argument that's unchanged. That's just how volatile this thing can be day to day. Again, going to say downvote though, but certainly one to watch, and always in the news, always making headlines. Next one on the list is Dell, kind of an old school tech company, but has been more, I would say, relevant in the last few years.
It has, and it's actually surprisingly outperforming on the year, up about 20% so far in 2023, up 16% over the last 12 months, and only down about 9% from their 52-week high. So a shocking outperformer. Who would have thunk that Dell Technologies would be faring this market so well, and outperforming today, up about 1.4%. Evercore ISI today did raise its price target to $55 a share from $50 with an outperform rating, and right now trading just below $48 a share. If you compare that to the average analyst price targets, which range from $40 to $55 a share, we're sort of already at the higher end of that range, or pretty much at the midpoint, I guess. But there is this surprisingly strong conviction among the analyst community. Morgan Stanley actually said earlier this month that the PC market is likely to have already bottomed, and a cyclical rebound has historically preceded the outperformance of then Dell shares. They actually said that Dell is now their most preferred PC original equipment manufacturer in the U.S. across all of their coverage. To me, that was actually even more interesting than this Evercore ISI note, Alex. And I would say the leading PC company from Morgan Stanley, that's a pretty bullish call. We do still have earnings for this company as well. And June 1st, I believe, they report. So we have that catalyst to look forward to here.
Yeah, and because we're sort of in that no man's land between now and that event, is going to be the primary reason I'll say downvote. But I think it's a really interesting story. I think whenever a name is outperforming the general market, outperforming its sector, not only just on a day-to-day basis, but generally for the entire year-to-date period, it should stick out to you, and it should be one that you look at and at least consider what's going on there. But again, going to say downvote here, in that limbo, really close to earnings, but just far enough away, possibly one we come back to in a few weeks. Final one, though, and this one really, I think, is an interesting story here, given the move size, is Ulta Beauty. Few names have been as strong as this company over the long term of the last few years, but it has run into some recent struggles.
It has, and I would say that this is a name where it's actually the only name we've talked about this week, at least in my near-term memory, Alex, where if you zoom out, you go to the max time frame on their chart, it really has been in a consistent uptrend. Didn't see really any major weakness, and at least in terms of the broader picture. When looking at the pandemic, it touched all-time highs on May 1st of around $5.56 a share, but you can see we've given up a significant amount of that strength just over the last month, with shares down about 11% this month, down about 12%.
I just climbed back up to VWAP. Real slow. Barbecue up a little bit.
Target today on Ulta Beauty to
plus 1.3%.
From 600 with an outperform rating. The firm does see strong top-line delivery, but more subdued bottom-line growth. They also now see limited earnings potential upside amidst an aggressive investment agenda, as well as a slightly more promotional beauty backdrop and a weakening retail discretionary landscape.
All right, guys.
which we are seeing a lot of this retail fallout today. But Ulta Beauty now only up about 4.5% year to date. It's way less impressive than when you zoom out, I have to say, but they do have earnings next Thursday before the market opens. So we also have that earnings catalyst to look forward to here in Ulta.
Yeah, and this is one where the story, I think, is just too big when you see that big drop in the stock. That I wanted to look at this one. And, you know, Jenny, I know that this isn't necessarily a space that I would consider myself an expert in, but I feel like I know enough to make this story, I think, interesting when you look at it and kind of explain the outperformance. Think about where Ulta fits inside this particular marketplace. They have sort of your traditional drugstore.
We'll do a lot for a
brands, but
firm
they
we
also
have
the
here.
higher end
Agreed.
brands as well. They're partnered with Target. They basically can get to all the different consumers. If we recall back to earlier in this week, we talked about Bath & Body Works, and one of the points Caroline had made was that we're not seeing consumers yet trade down within those type of products, the more cosmetic-based products. And I think that makes sense. If you're putting something on your face, you're using that as soap,
Oh, that gas sold
you're
off.
getting at a store like Ulta, it makes sense that you'd want to make sure that you have that consistent, high-quality product or whatever product that you use. But in the event that we do start
back
to
up
see
to the
that trade
highs,
down
7%.
effect, and what would arguably for many be staple products, Ulta can actually deliver those solutions
Wall
as well.
bounced.
Where one of their main competitors, a name like Sephora, which I know is not publicly traded though, Jenny, from my knowledge, is mainly just premium products.
It is, and Sephora is expensive. I have to say, both of these stores, you walk in, you leave, and you end up spending way more than you initially had thunk. But I think that Ulta has done such a good job sort of moderating and sort of finding what its consumers are interested in. Like during the pandemic, they were really, really selling big on skincare and at-home beauty products. But we'll have to see, of course, now how they fare because they did quite well during the pandemic. So I think those expectations are now very heightened into this earnings event. But we'll be diving into our two upvotes today a little bit further. We'll be looking at Disney as well as Ulta Beauty. We'll be looking at some example trades as well. Stick around. Next Gen Investing. We'll be right back.
You lost your Jenny sticker. Yes, you did. No more Jenny for you now. It just looks like a weird little robot. Jenny around it. That's what I'm drinking right now, Tasty. Oh, kitties. Relaxing hard. Hard flex. Still have the eagle? But we have the ego. Oh, you won't. That is the answer. Mavis 12.5%. Strong day. I don't know, man. I really don't know all the deal with barbecue and why they move stuff around so much. I have to look at all the different dates, but to me, they're in chapter 11. And so the end of that is full liquidation and, you know, bankruptcy. But in this phase, they're looking for you know, potential buyers, bidders that would like to purchase it before they close doors. So just as a broad overview of kind of scenario, if they're pushing deadlines, Well, for one, I don't know who decided that. Was it the judge? Was it the company? Who was able to say we want to push our deadlines back? But to me, it seems like the only reason why you push deadlines back is because of lack of demand, because you're trying to give more time for more buyers to come in. But could be any number of things. Not sure. But yeah, who's even the one that decided that? No. There's no evil in me, hombre. I'm an angel. Where's Jenny? Well, you have to summon her.
Are at a point where it seems like we may find some
There she is,
support.
summoned.
But backtracking a bit, first of all, we've been in a downtrend for quite a while here. Really since April of 2022, all the way back here is where it's starting. I took our chart back a little further than 1 year just to illustrate this. We topped out around here and around here, and that long-term trend line is still in play here. But really, you know, we had a shorter-term uptrend going across these lows that was snapped resoundingly with this earnings move here. And, you know, when something is not trending, you know, it's like you're paying
That is
anything
not
to roll the
any.
dice, and you want to wait for a clear
That is an
trend.
insult.
You want to find that, you know, a stock is having a convincing move in one direction or the other. Right now, it's looking more like the.
If it plays out like that, then yeah, it
angle
could
of
definitely be
things is
insane.
shifting toward the downside here. RSI, our measure of momentum, below the 50 midline, perhaps making just kind of following price action here, not really seeing.
I know. I
anything
think I might drop that
divergent or
GIF,
anything in the near
that
term
emoji.
here.
You guys don't use it much.
When we look at our other measures here, our moving averages, for example, we can see that all three of them are trending downward as well. They're diverging farther apart from each other. That suggests the downtrend is what's more prevalent here, even though we have a bit of a range we've established here between 91 and 101 here. So right now, perhaps range bound, but if we had to put a lean to it, maybe a bit more bearish. The 91 level, that's the point to watch to the downside. That's kind of our line in the sand here. If we do break lower, look for those yearly lows near 84.07. That could be another point to watch for some traction, and if we do get a further downward move here. To the upside, yellow 21-day EMA near about the 96 mark. That could be the first point to find some resistance.
96 mark, and Rick, it's crazy to me
You
that
keep
only a few
46%.
days or weeks ago, Alex and I were just highlighting that $100 level as sort of a base, but we've seen obviously that retest of some new lows here in Disney, and we've been sort of now stuck there. So when considering trading this name now, Alex, I think considering the fact that we have seen this ongoing weakness, we've yet to see any sort of rebound in Disney shares. Walk us through what you're thinking, then leaning into some more optimism.
It's hard to see. It's Ace Ventura.
Right now, this pessimism could be overdone.
So the IV percentile is 2%, and so while this is a bullish strategy, it's more of a reflection of the market conditions, and I would argue that it could still be perceived as a relatively
I know that's why people don't use it. I don't think.
bullish strategy. What we're looking at is buying
and tell what it is.
Call vertical, but very relatively small call vertical. Doesn't need a huge move to the upside or bounce back in these shares to be at max profit. The specifics on this one are the June 90.95 call vertical. If we could do this for a 250 debit, that's 1/2 the width of the strikes. The break even would be 92.50 on this one. And that would, of course, bring us to a situation where a break even is relatively close to where we're currently at. We're at 91.80 in the current share price, so 70 cents. A $90 stock, that's less than 1%. So you don't need much of a rally to get to that break even point over the next month. But this
The sad Jenny bad hombre.
Definition. We talked about sort of how this one has been struggling. Analysts are changing their tune.
Arrival 7.8.
Being shifted downwards. Downgrades are taking place.
Not even a new high.
So in the event that there isn't a recovery, in the event that this weakness continues to the downside or potentially breaks some of these supports, Jenny, we know the max loss as well.
And
it's defined at $250 and takes below 90. So this protects from some of the catastrophic downside, while at the same time has a relatively close to the current
options
price
for Jenny.
even.
You want more Jennies?
Also could expand a little bit if you do get just
no more Jennies for you.
You don't even need it to go very high. It only has to go above 95 to get to that max profit. Doesn't take much. So straightforward, classic low volatility.
Hughes flexing also. Bunch of Jenny flexes in here.
And of course, Disney shares only down about 2% today. I know that's still a pretty major move, but you read the headlines, you'd think it was down like 20% or something over the last week, which it's not, of course. 2% is not necessarily shares selling off by any means. But now to shift gears here and look at Alta. Rick, I was saying how I was looking at the max time frame in the rally here. It goes on and on and on and on. So I think that now the concern is with seeing shares falter from those all-time highs we hit back on May 1st. You know, the question could be right now, are investors starting to get a smell of something different here in Alta, a reversal perhaps?
Well, it looks like things could be turning a bit here. We had a long-term uptrend in this name, and notice as well how many times
poor Alta.
252-day exponential moving average
All
was
over for Alta.
in this name. So many times over
Alex.
here we can see that was where prices were able to regroup and continue upward here. But really,
You just
since
sound
this
bitter,
last dip,
Kitty.
our last touch of that line, we had been trending upward into yearly highs. Now we're still up almost 50%. We're up about 48% from those yearly lows, but the price action today has not been encouraging for the bulls here. We're in a downward channel that's been forming ever since we had this bearish engulfing candle right here after on the day that we hit those intraday highs.
Arrival, high in the day.
We've broken through our old
0.7.
lows near 501. That's this green dashed line right here that we can see was
255 is the high from back here.
We're perhaps looking for some support there, but we're breaking through it. We're even pushing below the lower boundary of our downward channel
split
here today.
squeezy.
So not really what you want to see if you were bullish in this name. It was looking like we were getting a little bit of bullish divergence in the RSI here, but it's not really playing out anymore here. The candle that's forming today is pretty big. We're near the lows of the day, so RSI is now following that downward, making just barely new lows with price. So the next point to look for some potential support, the 487 mark here
replacement parts?
represents where we saw some lows previously.
Oh, the little GM.
487 is an area to keep an eye on, and if that breaks, I mean, we could once again test that purple 252-day EMA. There's a volume node there. We can see that that roughly lines up with where that line is. So that could be, you know, there's two things converging at the same price point.
Maybe
so
bounce
that
up
could be
that
an area to
50
watch for
moving
some
average.
support as well. To the upside, 501
If it holds.
support becomes new resistance. That's the hurdle to clear once again. And then beyond that, we've got the confluence of our two shorter term moving averages near the 517 mark or so.
Yeah, Rick, a lot of technical indicators to consider here, of course, ahead of that
Pays and
earnings
pennies.
event, which is next Thursday before the market
Yeah,
opens.
just
So we'll
take a
leave it
break.
there.
Don't force the trades.
Technical insight, as always, Rick Ducat, our chart master. So now, when trading this
Chart
name, Alex,
master.
a little bit complex here, as we were just right around those all-time highs. We've since given up those gains, but now perhaps looking a little bit more compelling into an earnings event, because, like we've said before, it's sort of difficult to trade names when they're at all-time highs right ahead of earnings. So walk us through what you're thinking, then leaning more neutral to bullish in nature.
Yeah, well said. I think this is a chance for investors who maybe have missed out on this rally over the years to perceive this to be a little bit more of a contrarian opportunity. Lean into the weakness, possibly utilize some of this elevated implied volatility around this event, around this recent sell-off, to enter something more neutral to bullish. But of course, in the event, with that earnings event on the horizon, of course, as well, there's always a chance that this downturn continues and potentially even escalates. So I looked at something risk-defined and something that benefits from a basically stabilization of the shares. It would take an upside move, but doesn't need it for it to perform well. What we looked at was selling a put vertical below the market, because we're in sort of this awkward time frame with about a week till that expiration date, or for that earnings event rather. I elected for this illustration to go out to the monthly June cycle. A trader who wanted to do something more solely around earnings may opt for a shorter term options expiration cycle, or potentially even wait till closer to that event. But given the big move here today, given the recent sell-off, given that pumped up implied volatility, a trader who has maybe a longer term approach for Ultra, at least a medium term approach, and just seeing that earnings event as something along the way, may offer this longer term duration to June. Looking at selling the 475, 470 put vertical in specifically here, $1.50 credit.
Sounds good, Kitty. Thanks, man. Appreciate it.
$50 in risk as well.
Rusted Outdoor. That is a used GM.
Well, that's about 475. So you got about $15 worth of
14 calls, GME 25 strikes next Friday, down around 40%.
And then of course risk defined if this does crash
Add or cut?
70, within the realm of possibility.
This isn't really a good day to cut.
Over this entire time frame till expiration.
I don't know if I'd add either.
So always keep that in mind, particularly
Wait,
when selling
next Friday? Oh,
strategy. But this is an
I'm
opportunity.
guessing you got those yesterday or the day before.
Show signs of continued strength. To get into a name that has just come off all-time highs.
Yeah.
And quite frankly, over time, and I know historical prices are not indicative of future
I mean,
but has proved a lot of people wrong.
I would probably cut.
A really good comparison. Bath and Body Works had a really nice
I'd wait today. I mean, if you can keep an eye on it today, we should get a little bounce back up to VWAP. Maybe it'll give a little value. Or you could try on Monday. I don't know.
Because you do have to keep buying them, but we'll leave it there.
Had it for 2 weeks? No way. You never sold. You gotta take profits, man. Ugh.
Short options could be assigned at any time, and
Bill again, huh?
Index expiration could add additional risks like unanticipated.
You gotta sell when it's exciting.
Now coming up next, it's time for
Yeah, look at Bill, dude.
Apple that is clinging on to its gains for the day by dear life.
Look
on
at
all
Bill.
things AI, of course. Shares are up about 0.4%. We'll dive more into that story coming up next.
That's the thing with GME, dude. It sucks to trade now because it's just not moving fast enough. I mean, given your strike is too far out.
We explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option
Don't buy any strikes out of the money anymore. Just try that. Start with that. Only buy in the money.
Put or sell a call. Both strategies are bearish. But looking beyond direction to consider the impact
It's much easier to stay profitable if you're buying them in the money or right at the money. Because you might, if you're still in the money now, like you might be down a little bit, but the decay on it is, the swings are way smaller than if it's out of the money. So just this move today, that probably killed like all 40% of it. Yeah, close to the money and lots of time.
Full options for volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock
Hold till Monday. Yeah. Yeah, I mean, honestly, we might get a bounce Monday. But morning time is usually a good time to sell. It's more exciting. Volatility's a little higher. On a little bit of a pump. Oh, GME actually got a gap up there. Tiny gap. If anything, it'll probably be pretty flat on Monday. Probably not a whole lot of action. Next week it might start to rally, but you only have till Friday, so with those being out of the money, I wouldn't even try and hold it.
In uncertain times, it's tempting to retreat or simply wait and see. At CME Group,
yeah, that's too bad. It's hard. It's honestly, yeah, the GME options, like they're. I mean, some work. You can do it. It's just not. It's not like these crazy runs we used to have.
Major asset class to seize each possibility at precisely the right moment.
I bought options here, and I think I sold them here for like break even.
Welcome back to Next Gen Investing. It's time for a look at a developing story with Kevin Green, senior
That gas is coming down some.
network. So we just got some news.
Mavis 13.25%. Barbecue.
Text-like feature for Instagram, basically like Twitter, is what I'm understanding. Kevin, break down this news for us.
Genai. There you go, rival.
Anytime there's any sort of algorithmic change to Instagram, people lose their minds.
Definitely, yeah. So we are seeing
10. Are those biotechs?
That would be somewhat of an extension of Instagram, where they are able to compete with Twitter and utilizing their celebrity base in order to try to grow that platform, if you will. And as you know, there's several different platforms that Meta actually.
I don't know, man. These are sketchy to play these. You gotta know what you're doing.
Standalone, but you can also integrate them, which is a nice
ELBM is just bouncing off of an awful earnings.
You may not want to have Instagram, but you may want to have Facebook.
Oh, I don't like that one either.
An extension for this company in order to try to take market share from Twitter, and I think it's a very interesting offer to be able to have. Now we have seen the shares actually reverse. They were in the red, now they are in the green, or they were in the green for a little bit. We did see a slight sell-off here, but a little bit of optimism when it comes to Meta, especially with all the good news that's been coming from the company over the last 3 to 6 months.
Yeah, and Kevin, I find this fascinating as they're rolling out this new Twitter type feature for this summer release, they say, as I don't know if you've noticed this, but recently among my timeline, there are more spam accounts, more hacked accounts than I've seen ever before. So anecdotally, I'm like, maybe they should focus on that problem before now rolling out this brand new feature. But I guess in the social media space,
Budget gamble all.
people will just completely ditch Twitter for now this new algorithm.
Yes, age is up 8%.
Snap for TikTok. I mean, do you think that's really the case? Because I don't know about you, but again, personally, I find that they all can sort of coexist together. But then the question is, where do the ad dollars go?
That is a good question. I mean, at the end of the day, I think every platform operates and offers its own specific niche when it comes to the flavor that you'd like to have. I mean, for me, Twitter is really nice to have news, but I like to use Facebook still because I'm a dinosaur, I guess, in the millennial age group. But I like to use Facebook in order to interact with my friends and family. So I think it's going to be specifically on the needs of the consumer. And when you're looking at the ad space in itself, I mean, Meta has been able to capitalize on that structure for the last 10 years. And that's really how they've been able to generate a lot of their cash at this point in time. So they've perfected it, and that might actually cause a lot of businesses to actually start directing their ad dollars towards maybe this new product, whereas Twitter has become a little bit more of a political firestorm over the last eight months or so. And I think that actually has turned off a lot of advertisers going onto that platform because of the risk of, quote unquote, free speech or whatever you want to call it, but the risk of spam accounts, the risk of community notes. I think Elon actually noted that earlier this week that some advertisers pulled out because of community notes and things of that nature. So I think this is going to be a very competitive offer. Now let's see what Twitter does in order to combat, this offer that Meta is going to be rolling out here in June. It sounds like, or around the summer months.
And Instagram does still appear to be one of the most beloved. So I guess this is being seen as a positive, although we aren't really seeing that reaction in real time in the stock price. But Kevin, if you feel like a dinosaur, my favorite social media of all time is Vine, no doubt about it. I've never had Snapchat. I've never had TikTok. So I'm still operating back in like 2008, I think was the last time that Vine existed. But we will leave it there.
All about MySpace at the end of the day. You can put some music on your page. I forget that. I missed that platform.
Me too.
That's right, man.
MySpace. I wish we could go back to that time, a simpler time. We'll leave it there. Appreciate all the insight, Kevin Green.
I like that also. Yeah, put like my theme song on MySpace when you come to the page.
We are looking at Apple here, which
like put the embedded source code in your description.
Because I have to say that she's about 3 times 1%. I'm just sort of watching this strength, if you could call it that, even sort of
HKIT
the overall market. But I'm really rooting for Apple here, and we've got some AI news, which naturally is seen as a huge positive among the street analysts.
That rally.
Yeah, in the MySpace terms, looks like Apple took Microsoft out of the top 8 because they're banning ChatGPT for the employees. That's the story, and I think it's important to consider why they would do that, Jenny. Obviously, they're focusing
I see that. It's
actually
new.
exploring these technologies themselves, but to me, this is an admission that, hey,
it's coming down. Are you shorting this?
Farther ahead in this game than we are.
Pretty ugly topping candle there.
Competitors within this space or other companies in the entire world that Apple probably perceives as a formidable foe. Microsoft is giant the same way that Apple is giant.
And, I have to say that not necessarily like I put all of my faith in these major corporations, but this makes me a little bit concerned for ChatGPT. It was sort of like when companies came out and said they were banning TikTok from their company-owned devices. I was like, what do they know that we really don't know? But we did get reports they're worried about the potential release of confidential data by employees who use these kinds of tools, and it's told its workers to not use Copilot, the Microsoft GitHub tool for automated writing of this software code. The move then comes, though, very interestingly enough, as Apple is working on its own large language models, which I guess then you'd say perhaps they would make those more secure, more trustworthy.
We can hold. Buy, not even quite making the view up. Looks like it's
OpenAI announced launching its highly anticipated iOS application.
Slowing down its little rally here.
With assurances that it will be available on Android soon. Of course, this is available on Apple's App Store and is only available at this point in the initial rollout stages in the US. It will be available at no additional cost, they said, and they did say it offers this seamless synchronization of chat history with the web, as well as boasts a remarkable voice input feature, leveraging the capabilities of OpenAI's generative AI features. So this was confusing to me because first I saw this news that we are going to see now OpenAI roll out ChatGPT on iOS, and then I saw the headline that came out that said they're banning it for their employees. So, well, you're not allowed to use this feature if you're an Apple employee. You can still get it from the App Store.
You know, I have never used these technologies. I think they're interesting. I'm excited to see where it goes. But to me, this is somewhere between useful and hype right now. I think that AI in general, machine learning in general, data analytics, big data, all the things that we're using computers to basically be more efficient and get us further along down the road in really everything is great. But I don't need to talk to the computer to get every little thing. You know, sometimes I can go on Google myself and just look it up. I don't need to know every single thing. I don't need it to do homework for me. I'm not in school anymore. So just hasn't been the use case for me. But you can tell that these companies like Apple in particular, that want to be able to bring every solution to any problem, any need, any want to their consumers, how bothered they are that they aren't there yet and that Microsoft already is.
That is absolutely the case. It feels like right now it's a game of catch up with companies like Apple, Tesla, Amazon, Alphabet, of course, throwing their hat in the ring, but a little bit late to the game. And I have used ChatGPT. It's very user friendly. It's actually very cool, but I actually recently read an article that was written using AI. It was full of errors. It was so hard to read, so it's not necessarily a completely seamless process. But right now, it seems like AI dominates every headline. I
don't know how you could.
watching the evening news in Chicago, local news, and I was seeing that there was this headline that was
sounds good
basically
for it,
talking
man.
about healthcare in Chicago, the way it's going to start utilizing AI. And it seems like there's also that natural fear, right? Because there's the fear that it will take over the world, take over our jobs. I think that is what's
OEV kind of breaking out up 6%.
The fear of AI is something, it's coming. It's sort of like we all thought we'd be living in the metaverse at one point. I think just sort of accept the fact that we will see more things generated by AI, but there's nothing to necessarily be fearful of. But I do think that right now, if you're Apple, you want OpenAI's ChatGPT available on iOS. You want to be sort of seen in partnership with this company. You want to be ahead of the trend, not necessarily behind the trend. So will be interesting to see what their specific rollout of this voice-generated feature then looks like. But Apple has so many aspects of its business. It's even hard to say that this is moving the needle today because this is one of the most, if not the most profitable companies in the world. They are so massive. It's hard to say that this necessarily completely matters to their share price.
They have to make investments into this because if they don't, they're only positioned to lose. But they also have the money to do so. They have the money to do it right and continue to invest and compete versus the other companies. But they also got a core business that does pretty darn good as well. We just saw that with the iPhone numbers last quarter. From a trading standpoint, though, it's hard to not notice how strong these shares have been and how resilient they have been over the last year and a half throughout all the struggles of the overall market. You're talking about a tech firm, talking about a discretionary product maker, talking about a company that sells devices ultimately and then monetizes you after the fact. Fortunately, they sell a lot of them and they monetize it quite well, but it's essentially at its all-time highs. So a tech firm that didn't feel the weakness last year. So it's very interesting as it continues to execute at a high level. I looked at a trade that doesn't necessarily bet against it, but acknowledges that we're getting to sort of the high end of the range here. Air is getting potentially a little bit thinner, and potentially it's a little bit more difficult for this move to continue. Looked at selling a put vertical, very comparable to what we looked at in Ulta, but a completely different situation.
Barb coding up above
VWAP.
Green to red, 1829 in the top.
Basically at the money
and 18
You don't
bottom.
have much volatility in this section. The 0 IV percentile, an argument could be made that this isn't the right type of strategy based off those IV kind of components, but it's basically at the money. So I would argue that this is almost more bullish than it is neutral. Looking at selling the 175, 170 put vertical, $1.50, 30 cents on the dollar of risk, so $350 in risk. To the $1.50 max profit, 173.50 is the break even, just barely below
Rival
the current share price. So
8.73%.
Is Apple to hold on to
Agile
this level.
9.6.
Doesn't need to go higher. It would like it to go higher, but it cannot really go lower as it's only got 80 cents in cushion before that strike would be breached.
Yeah, and to speak to some of that outperformance you mentioned, it's up 35% this year. It's up 28% over the last 12 months. And like you said, pretty much at an all-time high, up 41% from their 52-week low. And if you look at the last 5 years, they've generated an average return of about 30% annually. So you could see why shareholders like this name. You could see why there is a lot of thinking that it has helped to buoy the S&P 500 this year, because we've still seen this strong performance from Apple, and a name that the street still really likes. I mean, the analyst community is overwhelmingly bullish on Apple still here. So always an interesting story, always interesting to discuss AI. It seems like there's a different headline driving that narrative every single day, but we will leave it there for FOMO. Now, coming up next, we will look at a completely different move today, and that is Foot Locker.
Gas with a bear flag on the 5-minute.
First quarter report this morning clearly did not please the street. We'll discuss those numbers with Renita Young coming up next.
For the letter to be you've read it before, right, Trace? The RC letter. You've read it before? The RC letter? An IPO and there's a huge naked short position. Stick around, bot. Leave a thumbs up. Mysterious MM. Oh, maybe there is. It's already IPO'd. Definitely gotten dunked on. Oh, yeah, it was a letter from a year ago for sure. That's funny. When you're just now reading it. They've basically done a lot of stuff he said in that letter. You have a 7.2 million float. I see 5.7. We go for another bot play. Last one didn't work. Or 0-1. No, just O. What are we? 0 for 0. 0 for 1. Let me check the volume. This does look like one of those Chinese stocks that IPO'd that might go crazy based on nothing at all. Oh, why? E-Trade, I can't see volume anymore. Oh, there we go. Oh yeah, it is low. Yesterday was 12.5 million. Day before was 14.9. Today's only 5. So you could still see half the volume come in though. The afternoon pump. And dump. Rival 10.5, little breakout there. 2,530. Do it. Do it. Do it. 7-4 on you, Arrival. Oh, what? They have options on this thing? That's good. Good if it breaks that. 255. I think it's on its way. Buy coming down a bit.
Effects as well. Stocks down almost 4%. This is seen as, hey, general weakness in athletic apparel and athletic footwear as well. So yeah, while Foot Locker might have its own things that it's working through, this was seen as so bad that maybe Nike's not selling shoes either. Any thoughts on that, or final thoughts on Foot Locker before we let you go?
I could have a couple thoughts on that. Just the fact that consumers are the main target for all of these items, right? And consumers don't have as much money as they did maybe even last week, you know, and so we see a lot of consumers making those decisions a little bit more closely on discretionary items, pulling back on how much they spend, and all of these items fall into that bucket, Alex.
Yeah, and Renita, I know I definitely don't have as much money as I had last week, so I guess I can relate to that personally. Although I do think the relationship between Nike and Foot Locker is important. I think that at this point we could say that while Nike impacts Foot Locker, it's hard for me to make the bridge that Foot Locker impacts Nike, because Nike is such a massive global brand, where Foot Locker, I'm like, it's such a store to me of yesteryear. But I guess we will obviously wait and see once we hear from Nike's quarterly results there. But we'll leave it there. Appreciate all of the insight as always, Renita Young, senior markets correspondent for the network. Now coming up next, it's time to look at DXC Technology, which is making a pretty interesting move today. Shares fell. Now we're up about 3%. George Tillis will discuss that more coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. It's time for Under 30, a post-earnings mover. It's been a bit of a roller coaster ride. We got DXC Technology. This company initially sold off on what appeared to be kind of a worse than expected earnings release, but something's changed because it completely reversed here and it's now higher on the session.
Yeah, because all of the headlines this morning were DXC Technology lower after some disappointing earnings, and now that narrative doesn't work at all, with shares now higher and actually slightly holding. They've given up some of that initial strength, but here to tell us more on this earnings event and why we're seeing that recovery here in real time, I'd like to welcome in George Tillis, Senior Markets Correspondent for the network. So George, DXC not looking too hot on a chart perspective, but today's move actually giving, I'd say, the bulls something to work with here as they completely reverse that loss.
Yeah, they completely reverse it. I surmise the reason why, and I'll explain in a sec, but this is sort of an overlooked stock. I mean, DXC, which was a spinoff from Hewlett-Packard Enterprises, it's effectively an IT consulting and outsources service-based business. They have two different divisions. They have Global Business Services, which is software and engineering and architecture and analytics for systems, IT systems. But they also have a global infrastructure business, which is a business that helps legacy on-premise IT services companies move to the cloud. So we know that that has been in high demand, but the challenge for DXC is there's a lot of competition. There's competition from companies like IBM and Oracle and SAP, Cognizant Technologies, Accenture. These are just a few of the larger legacy names that compete in the same space. I mean, Hewlett-Packard spun this company off to focus more on the development of data center in their server business, which overall has been a success for them. But nonetheless, DXC, as you did mention, is down on a year-to-date basis, and over the last year also it's down about 16%. Now, when you look at the report, overall they did miss on earnings. They were expected to earn about $1.04. They came in around $1.02. But compared to last year, that was a 21% increase despite the miss. But if you look at the sales, that's where the challenge lies. If you look at the inorganic sales, $3.59 billion, that was down 10.5% compared to the same quarter last year. $4 billion from an organic standpoint, sales were down about 2.5%. So initially you look at this and say, well, the trend should probably continue to the downside. But at the same time, if you dig a little deeper and look what's going on, they did report $1 billion share buyback. Now, for a company like Apple, that's not a big deal. But if you look at DXC, the market capitalization is only $5.4 billion. Forgive me there. And so over $1 billion in terms of a share buyback is close to 20% of the shares. And the other question is do they have the cash to do so? They do. They have $1.8 billion of cash on the balance sheet. So I suggest the reason we're seeing the move higher today, despite the miss on sales and, of course, the decline in organic decline in organic sales and decline in earnings, is the share buyback. It's so large that it's very compelling, and I think this is why investors are bidding it up today.
George, you know, admittedly, I don't look at this company that much. I understand that you kind of framed it as an overlooked stock. I can say personally it is an overlooked stock to me, but I can't avoid the fact that 5 years ago, almost to the day, was the high point on a 5-year chart, and this stock's 75% off those highs. So now I hear the positive is that they're buying back 20% of their stock, but to me this means they don't got any ideas on how to grow this business, and the best way to do that is, hey, let's just return some of this money back to the shareholders.
Afternoon, Jay from the Bay.
Might be exciting today, but that doesn't excite me for tomorrow.
Latest, not much new. Sorry, I left it on here.
Exactly. I was thinking the same thing, Alex. I was just going to bring that up.
Oh, a little pop out of that range. Barbecue might make a move up to 1925. I might put a little sell order for some if it does.
Outlook on deploying that in terms of capital expenditures, not even, of course, to make some smaller acquisitions, which may be accretive in the longer term. And I talked about Salesforce today on the Fast Market show, and you can actually see that their stock is improving after making a lot of acquisitions.
Rival 10.5. I like it.
Years. DXC, as you mentioned, is down, over the last 5 years, and it has to do with the fact that it seems to be weak in an environment where IT consulting and, of course, outsourcing services is facing a lot of competition. There are a lot of
break that level.
Players, there are a lot of
I'll still below
players. And for
need over 25.50 to break it.
Converted to the cloud, or at the very least a hybrid environment.
All right, I'm gonna
really left behind. So what I'm trying to say here is
use my position if barbecue makes it up here to 1925.
Larger enterprises have already converted to either a hybrid or cloud-based IT infrastructure. So I think that the sales growth for this
I don't know.
company is
I'll just
still
keep it. I'll leave it.
and competition has been very robust, and,
I'll leave
they
it.
don't
Never mind.
necessarily have another business.
I need to take off though, early. We're going to celebrate Mother's Day. A little late, but never the wrong day to celebrate your mother. So we're going to do some more extended Mother's Day celebrations today. Thought about leaving the stream on, but I think I'll probably just cut it off.
Reductions. While the average price target among analysts at
The editor, the producer doesn't like Jenny today. They're really not giving her much FaceTime. I don't like her skirt or something. Looks like barbecue might make a move up though.
Down 6% this year, down 16% over the last 12 months. I mean,
thanks
all we
DIY.
talk about is the strength
Thank you guys so much for your support.
that is not the case, of course, for DXC.
Ace, thank you for the gift of memberships today. Much appreciated, man. I don't know if he's around anymore. He's taking a nap. You too, Jay. From today, have a good weekend. Yeah, we'll see what transpires over the week. I could always, I guess, I can always close out later. I kind of want to sell some if it gets 925, but if it's ripping through there, I just want to hold for sure. But yeah, I'll just keep an eye on it, probably on my phone. If it does make it up here and just kind of wavers around like it did, then I'll probably reduce some exposure. Yeah, let's see. So barbecue's flat on the day. GME's down 4.5. Looks like it'll probably bounce up to VWAP before close. Bit of a take profits day. I mean, markets have gone crazy the last few days. Same deal with everything that's in the SPY, I'd say. Arrival, got some Arrival shares earlier, small amount, but I like the chart on here. That thing starts to go EV's up 6.5. Yeah, thanks Grumpkin, appreciate it, man. Yeah, follow us on Discord, or join our Discord. Follow us on Twitter at HappyMoneyYT, and Discord too. Maybe we'll do a Twitter Spaces if you guys want to do it. Let me know down. Sub up, like up, comment down. Happy Money sticks around. Have a fantastic weekend. Ready to come back next week. 5/22 Monday. Thanks guys, appreciate it. Thanks DIY, thanks Jay, thanks Batman, thanks Julian, thanks Tree, thanks Trays, Furious. I do want to actually put that on my watch list. MWG. I have to do it on my phone because I don't know where it went on the desktop. There you go, barbecue 1843. Yeah, breaking up out of that barcode. I think we could see 1925 again. So, but thanks guys. We'll see you this weekend. Discord, Twitter, maybe, perhaps. All right, have a good rest of your evening and a good weekend. Peace out.